Well, hello everybody. Good morning, afternoon, evening, depending on wherever you are in the world. This is the first of the Hudson sessions, and really excited to spend some time here. How much time? I don't know. I don't know what we're doing here. I have no idea how long we'll go today. I have a pretty good idea what we're going to cover, and I have a plan for us today. I also have with me three other members of my team. Betsy, Tom, and Annie are here. They'll be handling the chat and also fielding questions. So if you have questions as we go along, ask them in the chat. I'll do my best to get through the questions. We have a lot of questions submitted in advance, and I'll kind of sprinkle those through the session. But if things pop up as we go along, go ahead and use the chat, and let's get started. So a little bit about the book. These sessions we're planning a series of 12 here, and we're going to cover a chapter roughly each session. And as I said, this is not going to be just teaching what's in the book. I want to go beyond it. And I thought it might be kind of interesting to tell you where the book came from. I don't think I've ever really spoken about that publicly. I started trading in the mid 90s and took a little bit of a break after my first success to kind of consolidate and think about next steps. And I wanted a culinary degree, so I did that. And when I came back in the early 2000s, it was as the dot-com bubble was deflating. And that's when I started trading the S&Ps. And one of the things about my psychology that I think is a fortunate quirk is that I really do like to teach. And I say a fortunate quirk because the task of going through when you're learning something or you're developing a skill, whether you're teaching it or not, but the thought of how you might actually shape this and structure it and lay out in a logical flow to teach somebody. It's a great way to learn yourself. And if you are not naturally inclined to do that, you might push yourself in that direction. So even way back in the early 2000s, I was interacting with people online, and I taught a handful of people, and right away saw some uh, real spread of success. And at that point, I was doing okay, but I really did not know what I was doing. I was still struggling, and more okay than not okay, but I definitely knew less than I knew today. But one of the people that I taught even back in the early 2000s, who I've completely lost touch with, but she had early success doing, I think she was risking a crazy amount of money, got a little bit lucky, and told me that she was basically checking out and dropping off the map, and never heard from her again. I have enough money, I'm set. Good for her. And that I remember sitting around a campfire early in 2000, and early in the 2000s, and I wrote down some ideas about how the market moved, and that's out there as a blog post now. But that kind of became the seed of the book. And then when I was in New York after being on the Mercantile Exchange for a little while and spending some time at S&B Capital, and that's where Tom and I met. Mike Bellafiore, one of the principals of S&B, the MB there, encouraged me to write a book. And Mike had a lot to do with the kind of book that I wrote, and so did Linda Raschke. Both of these people really pushed me to write a book that would be accessible and practical. And I remember Mike's advice was, you got to write a book that's going to be a gift to the trading community. And that phrase guided the book. And over the decades since I wrote the book, honestly, I've strayed from that path sometimes, but when I've gotten more in the offshoots and more into esoteric things that really are a little bit difficult to tie back to practice, my work has suffered. So Mike's guidance was a shining star, and I thank him for that. Also had a great support team at Wiley. Writing the book was the first time I'd worked with a professional editor, and Meg Freeborn was just she I was a decent writer. She made me a much better writer as an editor. So that's how the book came about. I wrote the first draft of the book in 45 days, and it was about, if you have the book, it was about twice the size. It was a 900-page book, in which after literally on a Sunday night, the universe is funny. I finished the galley proofs, and this means going through, that's the last stage before the book is ready to be printed. And I literally had finished within 20 minutes of me putting it down, knowing that I was done with this project. It was in the can, it's ready to go. The phone rang, and it was one of my readers who said, "I think we have a serious problem. This book is far too big to publish." And then we went through the process of doing a whole nother round of edits. It's an absolute nightmare. And so ended up with the book that you have now. And what we pulled out was a lot of very nerdy statistical stuff, which did make its way later into the course workbook. Much of the material there was stuff that was left on the cutting room floor. And we'll also cover some of that later in these Hudson sessions. I'll give you some of the statistical support behind things. This quote you see on your screen here. So this is something, those of you who know my work and know me in social media, I can be really contradictory. In some of the things that we see in our field of trading education, I'm embarrassed many times to tell people that I'm in trading education because there are so many abuses. There are so many people scamming in different ways, everything from the 20-something kid who has no actual trading experience, and if he does, maybe he got lucky, and if he doesn't know that, and he certainly doesn't have anything that he can teach, and he's seen about 2 years of market action, if that. And then you have the people who are outright scamming with and you know what I'm talking about, right? The cars and the helicopters and models and swimming pools, and you can have this life trading 10 minutes a day. uh, so I'm very contradictory with that kind of stuff because I hate it, and I have a deep-seated hate for that kind of approach to the industry. But also, I'm the kind of person who lays awake at night asking questions. One of the questions that's been in my head over the past few months is, does it even make sense to talk about trend? Is the concept of not is the way that we're defining trend valid, but is the idea of a trending market? And this is a very foundational concept, and I do revisit that ground. I think about things, not to say nothing to the people who trade off of moving averages and Fibonacci, where they haven't actually done the test. So this idea, it's very easy you could go down rabbit holes. You could you could completely get stuck. So I think that there has to be, and this is something that I struggle with all the time, there has to be a correct balance of making sure you've turned over every leaf, but you also have to, I think, temper it with a little bit of common sense. This is the quote that begins the first part of the book, and I just wanted to put it here so we can all contemplate a little bit the value of doubting everything you think you know at least once in your life, and maybe multiple times. And I think if you understand this, I don't, some people on social media are nothing but attack dogs, and they just contradict, and that certainly is not my intent. And if you sometimes see my work and you think that that's how, yeah, maybe I had a bad day, so okay, sometimes I'm like that, but this is really what's driving it. And I would encourage you to, as we think about wrapping a scientific mindset around the problem of trading, that should be a principle that you keep coming back to. So in the preface of the book, I pointed out that the book does not offer a set of rigid setups. We are going to talk about some trading patterns. And spoiler alert here, we used the same patterns in the book with some tweaks. There's some things that I'm doing a little bit differently, and we'll talk about that over these next sessions. But essentially, everything that's in the book is as valid as it was the day that I wrote it. It's not really, however, about showing you my favorite trading patterns. And that's, of course, one of the approaches to writing a book, right? Show me your favorite setup, show me your best trades. And that's not the book that I wanted to write. I wanted to write a book that would teach somebody how, would guide somebody to the stage of becoming a trader, but also would equip you to think about trading problems and to think about how the market really works. So that's a lot of people get that. My email is full of literally thousands of emails from people who say this book was the turning point for me. You never know, right? When you write a book and you release it out to the world, you never know, is it a good book? Is it a bad book? Of course, it's your work, you love it, but the reception that this book has received among um, knowledgeable traders, I guess that's one of my initial thoughts, was to try to write a book that would take a complete beginner to successful trader. That book does not exist. I failed in that venture because it's impossible. I really don't think it can be done. But it is very interesting. Every now and then you will hear somebody say this book, doesn't really offer anything. And so some of the Amazon reviews say that, but generally speaking, I think if somebody has a little bit of experience behind them, they understand what I'm trying to do here. And I've been very, what's the word, honored, not pleased, but I've been honored to see how many people this book has helped. What are the key themes of the book? It's easy to get lost with this. And these are kind of reality checks up front. Trading is hard. And that is in stark contrast to, again, a lot of this is not good marketing, right? If we want to be honest, we would tell somebody who has never traded that trading is very difficult. Conservatively, 1 out of 20 people who tries to be an active trader is successful. And of those who are successful, some very small slice are wildly successful. This means that 95% of people, and I suspect the number is probably higher, who engage with active trading do not succeed. A lot of people fail. Now, that does not mean that you are going to fail. It does not mean that it's impossible. It does not mean that it's a grueling, horrible task. Far from it. It is and maybe this is a point to talk about how my thinking has changed a little bit. This really is not so. If you want to be a trader, many of you, and I know I'm talking to people who, again, are at different stages in the process. I think we have to be clear that one of the reasons you're doing this is to make money. And there's nothing wrong with that. And some of the psychological issues that, I do believe that some people who are struggling traders struggle because on some level they are afraid of success, or they have some deep-seated issues with their relationship with money. If you have those, you better resolve those. You need to be clear, this is a difficult thing to do, and if you're going to do it, you have a reasonable expectation. Only reason I can see to do it is to have significant financial success. But I think it goes beyond that. I think if you're going to do this, you have to love the process. And this means loving the discoveries. It means loving the failures. And I'll talk to you through these sessions about both some recent experiences I've had with both of those things. You also have to have, I think you have to have a pretty harsh view of how the world works realistically. This is this is competitive, and you're competing with some of the smartest and some of the best capitalized people in the world. And one of the things that a lot of people think, okay, I'm going to work harder than anybody else, and that might be true. And even if that is true, however, what I would gently suggest to you is that an institution, or it doesn't have to be an institution, frankly, somebody like me, one way I could attack the problem would be to hire 20 of you. So you are up against big forces in the market. This is difficult. In recent years, though, I have come, and excuse me if I get a little bit philosophical. Um, I was recently reading Jung, and one of the things that struck me, of course, I'm familiar with his work from my college days and from some other interactions with it, but one thing that really hit me this time, uh, as I was reading it, I was stopping occasionally, like reading paragraphs to my wife. Listen to this shit. Uh, he was massively destabilized and concerned by what he saw happen in society in response to the wars. And much of his work was based on the conviction that society was sick, society is damaged, society is suffering, and society is suffering because individuals are suffering. And this is why, he wasn't trying to start a school of psychoanalysis as much as he was trying to heal people. And when I look around the world today and we think about where are we today? And in some sense, it seems unprecedented, right? We have recently come out of the COVID, apply whatever label you think it was. Let's say pandemic. We're dealing with in the U.S. massive political stress and fractures. We're dealing with a shift in America. In some ways, has defined itself as a religious country for a couple hundred years, and we're starting to see some shifts there. And things feel really scary and really uncertain. And of course, the ever-present ostinato through human history. We have beats of war drums in different parts of the world threatening to break out into who knows what, right? And for half a century or more, we've lived with the constant threat of a nuclear annihilation. Like this is some heavy stuff. But when you look around, I think what people are suffering from, that there's a sickness that they aren't aware of. People lack direction and they lack meaning. And I personally have derived over much of my life, I've derived a lot of meaning from my relationships with people, from my artistic work, which I've recently come back to. Many of you know I'm a musician, I'm a composer, but also from trading. And this is something I'm going to challenge you to think a little bit differently about, because I think it's appropriate to think of the task of learning to be a trader. I'm suspicious of that language because you don't really learn to be a trader. You become a trader, you grow into a trader, you mature into a trader, but it's a quest. And I have touched on this theme in the past. There's an article out there where I use the monomyth, the Campbell story, goes back to Beowulf, the Lord of the Ring. It's the, kind of the one story that underlies all of the stories we tell, supports all the stories. I understood that was a key part of the trader's journey. But what I'm beginning to realize more and more in the post-COVID era and the political fracture in the US, this is also a quest for meaning. And there's a lot to be said with understanding probability and risk and your relationship to those topics and how you function as a being with agency and the world is uncertain, right? You could potentially get in your car, drive down the street, and die. Like this could happen at any point. We know this academically, but a lot of these probabilities are so distant that we think we can live our lives in a deterministic way. Not as a trader. If you are a trader, you are up against that avenging sort of probability every day. And it puts you in a mindset, it's also something that we're not going to talk a lot about psychology in this session because we'll cover that in detail later. But this will engage parts of your brain and a way of thinking, a way of being that is mostly untouched in human experience. And am I being overly dramatic to say that this is a quest for meaning. I genuinely do not think so. And I think if you commit to this struggle through your successes and failures, and you understand what the market can do for you, the same way if you're sharpening a knife and you have that stone that, how do you sharpen a knife? Think about that. What are you doing? First of all, you're taking material away from the blade, right? You're taking away what is useless and you're reshaping that, and you're carving out of that steel a useful edge. But I bet if the knife had a personality and opinion, the knife probably fucking hates that stone it's being ground against at that moment, right? And by the way, I will apologize for my language. I'm not going to try to filter this too much. So it's probably not appropriate for your kids. But after some time on a couple trading floors and in a professional kitchen, my language sometimes is quite colorful. So apologies for that in advance. If you are offended, I don't mean to offend anybody, but I'm also not going to change. So the key themes of the book: trading is hard. And I did not appreciate that overcoming these challenges could be seen as part of an internal quest for meaning. And I think that's incredibly important, and we could talk for weeks about that. Why is trading hard? Well, because markets are usually very close to efficient, and I will die on this hill. A lot of sloppy thinking traders will tell you that it's possible to crush the market. They believe that there are like dollars just laying around for any idiot to pick up. All you have to do is do this special option strategy or trade this indicator. That's not true. Anybody who tells you that is either lying or I'm struggling to find a nice word. Let's say they don't know. They're either lying, lazy, or not capable of knowing. On the other hand, though, you have academics who will tell you that markets are totally efficient. And when I did my MBA, I sat through these finance classes where they would explain market efficiency, and I would trade through many of those. I would scalp bond futures, and I would ask the professor, like, how do you explain this? I've made money basically every day, and the answer that came back was kind of interesting. One of my professors said that you're basically the mechanism through which markets become efficient. That's pretty important, right? Because markets, we'll talk a little bit more about market efficiency, but the assumptions are deeply flawed in those academic theories. And even if markets at their end are efficient, there has to be a process to get there. There has to be a process. What efficiency means is information comes into the market and price instantly goes to that correct value justified by the new information. And that's how the theory says markets work. A lot of academics believe that, but then there are these jokes, right, where you have two economists walking down the road and they see $100 bill on the ground and they don't pick it up because, of course, there can't be $100 bills on the ground, right? That's not exactly the joke, but that's the idea. So what this means to you practically is that trading is hard. And this is why trading is hard, because you have a lot of people who are combing new information when it comes into the market, and the market is very close to correctly priced most of the time. And this means, here's another hill that I will die on. And a lot of people have contradicted this, and I'll show you here later today what I think is some proof that this is true. Market movements are largely random most of the time. So if you don't want to get deep in the weeds of the concept of randomness, and again, there are people who spend a lifetime studying that. There's certainly people who have mathematical knowledge that makes mine look minuscule and insignificant, who understand these topics in a way that I don't. But I'll tell you what you need to know practically is assume any point you look at the market, what it's doing is probably meaningless. It's probably just bouncing around in a way that doesn't mean anything and is not predictable most of the time, not all the time. If you are a new trader, if you frame your thinking in that frame, that will set you on the right path. Because of this, it's difficult to make money trading. Now, again, what do I mean by that? Every time I say that, there's going to be somebody who says, no, I bought Bitcoin and I forgot about it for 10 years and I made $5 million and that was pretty easy. Okay, so that's an example of getting lucky. And there certainly are other ways we can get lucky. You can short something and forget about it. You can just happen to buy a cheap stock that explodes, right? But out of money options, who knows, right? But what we're talking about in all of these cases is the idea of doing something over and over and over. It's very easy for you to make money on any one trade. It's quite difficult for you to make money and to keep money over hundreds of trades, thousands of trades, tens of thousands of trades. I remember standing in the shower one day thinking a while ago and thinking, how many trades have I done? And I realized it's got to be way over 10,000. And that's where you want to be when you've done many, many, many trades. That's what we're talking about, making money. Anybody can be lucky or unlucky on any one trade, but we're talking about a large set of trades over a career. And for you to be able to do that, you must have a verifiable edge. The title of this book, The Art and Science of Technical Analysis, it was almost called Signal and Noise, and some variation on that, with the idea, that was one of my editor's suggestions, was to talk about how to pull out what is true from what is not true. And that is or what is meaningful from what is not meaningful. And last week, I was just walking around Wall Street again and remembering that one of my old routines, I don't think I've ever told anyone this publicly. Wall Street is, for those of you who don't know the geography of New York, it's an actual street. And the joke is that there's a harbor on one side, so it opens into the East River, which is actually like this picture behind me. And then there's the actual street, and there was a fence there that kept the livestock on the tip of the island back, I think, when the Dutch settlers were there. That's where the name of the street comes from. And then at the other end of Wall Street is Trinity Church with its graveyard. So that's one of the jokes about Wall Street, that there's a harbor at one end, you bring the people in, and then there's a graveyard at the other end. And in the early mornings before the markets would open, I would sometimes duck into Trinity Church and just spend kind of a few moments in reflection and meditation. It's very strange to walk off of a very busy Manhattan street into a space like that. And what I would invariably think about in the coming trading day, I would think about discernment. How could I know the real from the false? How could I know what was deception versus what was real? So the idea of signal and noise, when my editor suggested that, really resonated. I was also doing a lot of very nerdy statistical analysis to support the book. But I came to this art and science idea because I think it's more true. We got a question, one of the questions that came in. I'll read the question. In the last paragraph of the preface, you described how trading is both an art and a science, and they both depend on each other. I said something like, science without art, science depends on intuitive leaps also. Science without art is sterile, and art without science is weak, or something like that. I'm sure this still holds true after more than a decade. Are there any new insights into this thought, or how this idea has evolved over the years? And how did I come up on this discovery? Well, the how was that I was both an artist and a scientist myself. My formal training, I was a classical musician. And while there is something very analytical about the task of composition or learning to play an instrument, there's also pieces of that that go beyond that. We can't exactly explain why something works. If we look at a piece of music or a poem or a story, we can quantify it. And I don't know, let's have this discussion in a few years when AI has evolved a little bit more too, right? But I also knew from my experience trading that there were a lot of people who thought about it in a completely loose and maybe artistic way. So the idea was that that I was looking for was that you really had to have both. I think if you want to be successful in the long term, you have to do some statistics. You have to have some structure to your thinking, but you also have to leave some room kind of around those margins. This is not one of the quotes that people throw around. I said the market's not a math problem. I don't think that's in the book. That came from someplace else. It's easy to think the market's a math problem because the language of the market is numbers, and the market produces a stream of data, and it looks like something we can, in fact, turn mathematical tools to that. But the task of understanding trading is really about understanding what produces that data, which is human decision making, which relies on both reason and emotion. So my belief, maybe perhaps it's wrong, but my belief is that you as an individual trader are probably not going to be successful until you can take these two seeming opposites and meld them together into a whole, until you can equally comprehend both the art and the science. And you might put up against me, you might throw up, for instance, Renaissance. And those of you who don't know Renaissance and their track record, Google. Uh, by some measures, the most radically successful trading record of significant real money ever. And their approach is extremely scientific. They hire PhDs, math, and I think maybe actually just math, maybe not even physics. But they don't hire traders, and their approach is purely analytical. So, is that does that prove that you can do this with just science? Well, I would bet there's still a bit of art in the application there, and the things they are analyzing, where they're finding their edges, relies on the many of the distortions that they must be trading are, and one of the lines of business that we had for many, many years was to advise quant firms and even to write code and give them trading signals. So we do have some insight into people who trade like that, what they look at and the kinds of ideas they put together. And even if they are approaching it in a very scientific way, they're still dealing with human emotion and the artistic side in some ways. So why is this book about technical analysis? Why technicals? And most of you noticed a 10-second detour. Technicals mean that we trade, and by my definition, we trade on information in price changes. People typically think price charts. I would not say that is true. You don't need charts to trade technically. If you're trading an algorithm that uses price data as its input, that is a technical trading system, even if you never look at a chart formation or a moving average. The other side is fundamentals. Fundamentals use outside exogenous information, primarily macro information. If you're looking at a company, you might want to know about its financials or its competitive position. You might also have some things that kind of border on narrative, like maybe you're assessing management, maybe you're looking at the how much debt the company has. You're looking at aspects of capital structure there. Why do I focus on technicals? So we do have some questions about this. I want to point out that fundamentals do work. The idea that either one of these is better than the other, I think, is pretty radically false. Technicals work, but only a little bit. Fundamentals work, but only a little bit. If you mash them together, do they work better? Some people have written books suggesting that is true. I do not find that to be true. What I find is that what people think work with fundamentals, and one of the questions was, have I done back testing on fundamentals? And in fairness, not for a decade, because I did a boatload of really heavy duty statistical work on fundamentals, and I found that most of the things that people look at do not work like they think they do. Most of the people who are doing, and when I say most of the people, I mean even analysts on Wall Street, and certainly people selling services. If I'm going to find the company with the best fundamentals, what actually works is not what people think. For instance, one of the things here's a very simple example that I've given before. Companies can have different amounts of debt, right? And we have this idea that debt is bad. You don't want to run up giant balances on your credit card because that's stupid. Um, so a company, we think we might prefer a company that has no debt, right? You would be wrong. And so, it's things like that. But so a lot of people, if they're going to screen for fundamentals, one of the first things they might put on that screen is have a company that has a low percentage of debt. So, and somebody who's doing that, how do they know if it works or not? They don't. And I think this is an epidemic in fundamental work that people are using logical things, but the world does not work in a logical way. And I could explain to you why high debt is a good signal for a company. And here's a hint: it has to do with leverage. And if you think about what's actually traded in the stock market, it's the equity piece, right? So none of this is inexplicable, but it's counterintuitive. So the other issue with fundamentals is fundamental data doesn't come out very often. If you're trading stocks, pretty much fundamentals are released 4 times a year. If you're trading economic reports, maybe they come out a month, maybe they come out 4 times a year. So I like to work in a pretty short time frame. And you will see people who tell you they're trading short-term fundamentals. I think it's utter nonsense. What they might be trading is when an economic report comes out, or let's take a better example. Let's say a drug company is denied an approval on a new drug. So then the stock moves a lot, and a lot of volume is going to come into the stock, a lot of trading is going to come into the stock, and day traders might be able to trade that more successfully than they could when the stock is quiet. Is somebody doing that trading fundamentals? No. No, 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 no. What that person is doing is trading the activity. They're trading the imbalance. Come back to that in a moment. That is generated by people trading in response to that new information. That person is not carefully analyzing that release and finding out what the stock is supposed to be and then trading for the stock to go to that price. That's not what is happening. So I don't think fundamentals have much influence on the kinds of time frames that are interesting to me. Tom and I have continued to do a boatload of fundamental work, and I'll point out we put a lot of that out for free. We ran an institutional advisory service. I ran an institutional advisory service going back to 2009. It went through a few incarnations. And frankly, I decided what I enjoy most, crafting the life that I want, doing what I want to do. I enjoy teaching individuals and small teams of people how to be successful traders. So I've changed my public facing business to move away from the institutional side, at least for now. And it's a little piece of gold that's out there that people don't really think about. But what we've done is we've taken all of that analytical work that we used to distribute exclusively to institutional clients, and it's free. Go to talentadvisors.com. You can sign up to it. Sign up there, and we'll send you the data for free every week. We also do every quarter quite a bit of work on some macro models we have, which are powerful and they work, but these give us influences at the 3 months, 6 months. In some cases, we have, like with the yield curve thing, I think we have a very strong signal for some time between 6 months and 2 years. So that's a pretty difficult thing to trade, right? We continue to do a lot of this fundamental work, but it doesn't actually find its way into our practical decision making. We talk about it a little bit, but it's not a critical part of what we do. And the most important thing to know about fundamentals, I think I just answered that. We also hit news and narrative. Let me check the questions here. Do we do fundamental back testing for long-term investing? A bit of that, but even with, and do we long-term invest? We do. I do think, I'm very critical of some of the indexing approaches, because indexing means people telling you You can't beat the market. So all you should do is, the only thing that makes sense for you to do is to put money in the S&P 500 or whatever, and just don't touch it. Dollar cost average, buy a little bit, and treat it as a money making machine. It'll appreciate about 7 to 8% a year, and take it out when you retire. I think it's a reasonable approach for some portion of your net worth. And yes, we do that. We also do some opportunistic things on the longer term. For instance, we bought a basket of stocks that were damaged quite badly in the COVID flush, and those did quite well. Those recovered quite well. We also bought, well, I think so I came down a little bit hard on the scammers, and I will continue to. One of the warning signs, I think, that somebody is lying to you is if they only tell you about their successes. Yeah, in my experience, if you talk to people who are actually doing this, what you're more likely to hear is all of the ways they have failed and all of the dumb things they've done and all the trade. You'll see traders sitting around and just talking about, oh, well, you did that, well, I lost, like, so here's what I did. Can you beat this for stupidity? And we bought a bunch of Russian stocks at the beginning of the war, and that didn't work out very well. So there's these things don't always work out, but even in the longer term, we do find ourselves pretty heavily technically motivated, and this is always something that we're kind of chipping away at and thinking about. But I have no, my approach is it's kind of like Bruce Lee's ideal, right? Where you take from every discipline what is useful, you discard what is not useful, and you maybe have a little bit of something that is new and uniquely yours. That to me is the ideal way of developing a trading approach. And I've been all over the map. I have, and I think maybe I should have put this more up front, but my trading experience, I've been a tiny trader, I've been a big trader. I've done the dumb things that some of you have done to get to this point in your trading. I've done all of those things, and I've probably done dumber things. I've had accounts that were ground down to a few $100s. So, I did a YOLO on options. I've had accounts that were almost blown out, and I don't even remember what I did. Like, did I double up? Or I think one time I flipped and doubled up. So, just make sure you can lose every possible way. And I've also seen my P&L tick 6 figures in a tick. So I've kind of been all over the map, and I've seen a lot of different ways to do this. And I think that you have to figure out how to put all of this stuff together in a way that works for you. There's also questions here about back testing, and I'm going to push those off until a later session. So I'm going to ignore the back testing questions now, and we certainly will get to those in the future. So let's talk a little bit about expected value. Now, I do think that this is much, when I wrote the book, of course, you could hear people talking about expected value or expectancy. Van Tharp, I think, was probably the person who articulated that with the most clarity, that idea with the most clarity to people. And now a lot of people are talking about it, but I think there are a few points with expected value. So what is expected value? Expected value is there are kind of two, and I really should have put these here and I did not. There are two ways to do it. One is the simple formula, where you take your average win times the probability of the win, and you take your average loss times the probability of a loss. Now, you can do that either with, so where do these numbers come from? The only valid place that they come from, the most valid place they come from, is actual trading results. So I'm not very much interested if you tell me, hey, I have this system where when I win, I make 3 R. We talk a lot in R, and R just means what you're risking on the trade. It's a nice way to talk, because if you're a tiny trader, currency trader, trading micro lots, like, and you're risking $10 a trade, then $10 is 1R. And I can have the same conversation I have with you that I would have with somebody who's trading a giant account and risking $50,000 on a day trade. That's his 1R. It's 1R to both of you. So if you have that standardized loss, R means risk, and you're telling me that your wins are 3R, so you're winning 3 times what you're risking. And if you tell me that I win 75% of the time, okay, well, first of all, I know when you're telling me that you're living in fantasy land, but you might legitimately think that is true because maybe you've seen it from a back test. Maybe you have some other reason for thinking that, but where the only place that type of analysis gets really real to me is if you can say, here are my realized trading results. And Bruce just said Van Tharp took a lot from Ed Seykota. I think that's true. Yes, I do believe that's true. Ed is still a source of wisdom. It's a little bit hard to find some of his stuff out there, but everybody who has interacted with him has come away changed in significant ways. The other place where that type of analysis might be valid is where you're looking at a forward test. So, and we also can get these numbers out of a back test, but see, the further away we get down the chain here from real money, the more suspicious these get. Notice in that math, so you're multiplying your average win times the probability of the win, average loss times the probability of the loss. Where are the break evens? We don't need the break evens, right? Because there's zero. So that you would be adding a zero. And this also points out that if you do this math right, chances are your probability of win and probability of loss will not sum to 1, and that's fine. The other way to do it is how I put it in the book, where you consider every possible scenario. Formally, it is every possible scenario times the probability of that scenario, and that's also impossible to articulate with perfect fidelity because you never know all of the scenarios. But one of the issues with both of these is that these are, so expected value tells you, if you have this number, what it really tells you is every time I risk $1 in the market, this is what I expect to make or lose. Imagine a system with a perfect negative expectancy where what's a negative expectancy? You just give somebody $1 on the street, right? That's a -1 system. Person's probably maybe they won't always take the dollar, but pretty much anytime you offer the dollar, every time you trade, you lose $1. That's a -1R expectancy, and then a zero expectancy would be that it would average out. It doesn't mean, of course, on every trade you're going to make zero. We're talking about averages, and that's the problem because this is an incomplete picture. You could have a trading system where the wins and losses are very consistent. You could have a system where, for instance, a lot of kind of classic trend following systems might have a lot of very small losses and then some gigantic wins that offset everything. So it's just important to think about, and if you're not particularly mathematically inclined, and hey, I feel perfectly comfortable saying that because there was a point when I was not particularly mathematically inclined when I was a musician. And I had one math class in college, and it was kind of jokingly called it math for poets. They would introduce us to mathematical concepts and we'd kind of talk about how it made us feel. It was not particularly rigorous, let's say. And I know that one of the things that's out there in the cognitive and educational literature is that people are kind of one type and they can't change. You can change. You absolutely can change. And I think if you're going to be a trader, you do need to organize your thinking toward at least toward some pretty rigorous quantitative thought. I saw one of my quirks is that I was always quite good at standardized tests, but there was a distinct difference in my math and language scores. my language scores would have been like, 99th percentile. My math scores would be quite good, but not there. Once I went through the process of trading, and when I was taking standardized tests to get into grad school to do my MBA, I saw that my maths had actually increased, and my math strength had increased. I kind of reallocated intelligence points or something. I don't know, but I'm quite convinced that with a lot of very focused work, you can change your brain, and you can change your cognitive machinery. And one of the things that should be intuitive to you, must be intuitive to you, I think, is understanding the difference between reality and an average. An average is a model, it's a representation of reality, but it doesn't mean if I tell you that here's a giant room full of rocks, and the average weight of the rocks in this room is 100 grams. It doesn't mean there's a single 100-gram rock in there, right? It could be a handful of sand and then some giant boulders. And so the average might not actually tell you anything about those rocks. The average might not tell you anything meaningful about your trades. And that's something to think about that might get lost in the expected value. These things do, when we do further analysis of trading results, and a very useful thing is just to plot an equity curve, we do see where those those things fall out. One of the things that I think is particularly silly that you do hear people talk about a lot still is some people are really focused on high probability trading, and other people are focused on high risk reward trading. And frankly, I didn't use the word dumb here lightly. Both of those are dumb. Anybody who the problem is, like, once you brand yourself as something, it's a problem. I guess this goes back to my Bruce Lee approach, right? If I branded myself the moving average bend trader, so imagine that, okay? Or I could call myself the Fibonacci maestro or something. Once I do that, I kind of lock myself into using those things. And if I define myself as the high probability scalper, then it affects. It's a thumb on the scale that keeps you from moving toward maximum trading efficiency and power. And I do think a lot of gurus do this. And one of the things that, even in my opinion, very smart people miss is that your win rate is influenced by the size of your stop and profit target. So for instance, if you were to, the way to think about this is, imagine you were just randomly entering trades, and you used a 1-to-1, 1 hour target, 1 hour stop. You did that for a while, and then you increase your target to 5R. What's going to happen? Should be immediately obvious. And if it's not, then this points out that I think a way that you might need to think about these problems in a little bit different way. If it's not immediately obvious to you that scenario number 2, you're going to win a lot less often because that ratio is different. Then you need to think a little bit more about how markets bounce around. Hidden value of expectancy, and this is not in the book. This is something I've realized over the years as I've taught options to more and more traders. This skill of thinking in scenarios is absolutely critical. So what this means is, this is a very, very practical thing. So if you look at a market and you look at a pattern or a situation, and you can say, I think there's a really high chance of this market going up, fine, maybe you're even right. So you'd put on a long trade. But what you better do is spend some time thinking about, that's a scenario. The market goes up. Force yourself to think about the market going down. What would that look like? How would you know that's happening? What kinds of patterns would you see if the market were going down? And then we should assign those some probabilities. And then you should assign yourself here's one of the tricks that would, this political BS I was talking about earlier. People have opinions they have beliefs, but I think one of the things that is missing, where did this come from? Some famous scientist was a huge advocate of, I mean, all scientists think like this, but you need to assess how certain you are that you're right. So not only do you look at this market and you say, I think there's a 60% chance of it going up. You might look at it, you might say, hey, it's going up. And then I just challenge you to think about the downward scenario. So, then I say, how sure are you it's going up? Well, if you were a new trader, you might have been, quote, 100% sure. But now that you've had to think about the downward scenario, you're not 100% sure. So you're like, oh, maybe I'm 90% sure. And then you think about it a little bit more. You're like, how sure are you that it's 90%? Well, not really. So you go through this process, this kind of, it's a little bit of maybe a Bayesian approach of revising your estimate of probability and how certain you are of probabilities. This is, you might say this is abstract math, right? No, it's practical. This is what you do every time you put on a trade. You go through this process. Eventually, it becomes a habit. This is one of the habits of successful trading. Folks, let's finish this slide, and then we'll take a little bit of a break. We are going to take a few breaks this session just to give my voice a rest, but let's finish this discussion up. Once you're thinking about up and down, I would then encourage you to refine that a little bit more. What's missing? Sideways is also a possibility. Or as I like to say, failure is always an option. So, you think something's going to go up and you're aware, okay, so this breakout fails, it might collapse. Let's just remember, like, the wah-wah sad sideways outcome is absolutely an outcome. And then I would further force myself and traders I work with to think not only up, flat, down, let's also add a big up and a big down. So what this means is, for instance, if I'm buying a stock, let's think about the nightmare scenario of the damn thing gapping down 25% tomorrow and gapping 5R beyond our stop. Because you do this long enough, it's going to happen. And if so, the first time I think about that, you might go, oh gosh, okay, I'm not going to do that trade. Well, then you think about assigning probabilities and you think about the offsetting upside gap, right? And this will train you to think in scenarios. This is not something that you can do overnight. It is a critical skill to cultivate. And I do think you also need to understand probability. And again, here, I mean from a very practical perspective. I don't mean that you understand necessarily the deep math behind it. I don't think that hurts anything, but what you need to be able to do is to imagine that you understand probability well enough that you could be a successful gambler. Yeah, or to assess the probabilities in a game and say, I shouldn't play that game. There's no possible edge there, but a very practical understanding of probability. Trading will give, trading will give you that. You need to cultivate that, though, because you're not going to be successful as a trader until you have that, and it has to be intuitive. I think it has to be both intellectual and intuitive. We'll talk more about intuition later. If you don't have an edge, nothing will help. This is also one of the common misunderstandings. People tell me that money management is an edge, or my edge is I'm passionate about markets. Get out of here. First of all, being passionate about markets is one of the phrases that comes up a lot in my thinking, is necessary but not sufficient. So yeah, you're not gonna be a good trader unless you're passionate about markets and you're passionate about trading. If that's not true, you stand no chance of being successful. However, it's not enough, because everybody you're competing against is passionate. Everybody you're competing against who gets past the point of those early blowouts is probably pretty disciplined. They probably have their psychology mostly aligned. The irony here is, though, all of these things are very important, and that is one of the reasons why trading is so difficult, and maybe why it's appropriate to think about it as a quest, because you have to have all of these pieces working. There's no one thing that is most important. The one thing is that you have everything. Okay, let's take a little bit of a break. We're gonna take a 5-minute break. I just started a stopwatch. I'll see you back here in 5 minutes. Okay, welcome back. 5 minutes is 5 minutes. So there's a question here. Couple actually. Should we take a course focused on probability? I recommended a couple books on probability. We're going to send out some show notes afterwards, so you'll get an email and we'll link the book. There are a couple books to read on the topic, and look, it's a matter of available time. I think taking a course in every aspect of this would be interesting and worthwhile. You know, personally, I've considered taking some more courses and just kind of general math and deepening my skills there, but it's also kind of a matter of time and payoff, right? I think most of what you need to learn about probability, you will get from thinking about market problems. You'll get from the books that I've recommended, and nothing wrong with taking a course. If you do want to think about topics on which a course would be useful, this is up there near the top. Thinking in Bets by Annie Duke. Thank you, Bruce. Just I saw that in the chat. It's one of the better books I've read over the years. I read that book twice, and it's a very, very good book. Another question, do I think high probability trading works better for beginners, at least psychologically? So the issue with high probability trading is that the way you're going to get there is by having a profit smaller than your loss. And there are some issues with that in terms of execution. The bid-ask spread becomes a bigger piece of that profit, and particularly if you're a short-term trader. I think as a short-term trader, one of the practical, you didn't plan for these talks to have any like clear structure, I hope, because now we're talking about really practical trading things. If you're a short-term trader, I think it's important to try to do one side of the trade, either the entry or the exit on a limit order. So you basically can be a price maker or a price taker is the way to think about it. And if you're using a market order, or you're getting in and you're overlapping the offer to buy, so you're taking that offer, you're hitting the bid to sell, you're paying the spread. You really probably don't want to do that on both sides of the trade. There will be times that you have to do that. Excuse me, when would be a time that you have to do that? Let's say you enter a breakout on a stop. It's probably a stop. You're going to be paying the spread there, and then your trade hits its protective stop. That's also probably going to be a market order. So in reality, less than 50% of your executions will be on a limit, will be what we call more efficient. Don't think, by the way, let's say you're getting, and options traders are bad about this. Let's say you're doing that breakout trade, and then you're putting let's just say breakout levels, I don't know, let's just say it's 10, okay, right? So market goes up above 10, and let's say you put your limit to buy at 10 and 1 cent. And let's say the spread's now a 1 at a 2. And then let's say the market goes up. Now it's 3 at 4. So you move your order up to 3. And now it's 4 to 5. So you move your order up to 4. So you're on the bid. And then it comes down. It's 3 at 4. And then you're filled. Did you just get filled on the limit on the bid? No, you did not. What you actually did was, and a lot of people think they're using execution skills by moving orders around like that, but at the instant of that breakout, the thing was bid at a 1, offered at 2. Maybe there'd been a little bit of volatility, been a little bit wider, but you get my point. I'm using a very strange example, but you actually ended up paying a few pennies above that offer. You would have been better to just take the offer and execute on a market order. But the problem is that I imagine if you're a beginner, most of what I just said, your eyes kind of glazed over at. If you're a beginner, you're up against that. So what I'm saying is that if you don't intuitively understand everything I just said, that's something that a more experienced trader would know intuitively, but that's something that's going to be a continuing cost for you. So no, there is definitely the question of matching a trading approach to psychology. and that's a big one. I don't want to get too deeply into that today, but I think there's also value in, if you think you're a trader who needs to be a high probability trader, there's also a little bit of a value in like kind of coercing yourself to be a little bit of a different kind of trader too. And it's definitely a balancing act. For instance, I'd be a really shitty trend follower. The idea of losing on 7 trades in a row and then making 15R on a trade, that is not how I want to live my life. I have no desire to do that. And so I know that that's something that not only does not suit me psychologically or temperamentally, I just don't want to do it. Let's go on here. So I kind of jokingly wrote this in the book. This is a quote that I'm not going to read this whole slide to you. You can read it. I just want to highlight a few things. So first of all, there's no holy grail in trading. That's the most important thing at the bottom of the slide. But this is close. And if you're a struggling trader, this is one of the real keys. I remember when I realized this, I don't think I slept for a day and a half. I was so excited that, and this was many, many years ago, and this is one of those revelations that has stood the test of time. So every edge comes from an imbalance of buying and selling pressure. And if we limit our involvement to the points where those imbalances exist, we might have a chance. So this goes back, this is, go back a few slides where I said, you look at a market, what the market is usually doing is bullshit. That's the technical term. If you just pull up any chart, if you glance at the S&P 500 at any point during the day, and you're like, "What am I seeing?" and you ask yourself, you say, "Self, what am I seeing?" The answer that should come back instantly is, "I'm probably seeing bullshit. This is probably just mostly the market bouncing around randomly. And if I go try to trade noise, I can't have an edge. What I have to wait for is some evidence that there is an imbalance of buying and selling pressure in the market." And one of the questions I have here from Thomas, which actually he and I discussed a few years ago on Twitter, he reminded me, is can I talk about the phrase, "There's more buyers than sellers," which we hear on CNBC all the time. So that's not really true. Why does a market, this is the classic incorrect answer. Why does a market go up? Because there are more buyers than sellers. That's the like old school answer. It does, however, get you close to a truth. The reason the market goes up is because people want to buy it more than people want to sell it. Now, the person who wants to buy it could be one big trader, or it could be thousands of little undercapitalized traders on from Reddit using Robinhood with $200 accounts who are driving a stock up because there's millions of them, right? Like it's not that there are necessarily more buyers. One really convicted seller could smash thousands of buyers. It is, however, the conviction and ability. So, you might look at a market. Let's say you're a small trader. You have let's put a number on it. You have a $500 account. You have a tiny, tiny account. And you might really have utmost conviction that a market's supposed to go up. So like you're all in, you'll do whatever you can to buy, but whatever you can, the limit of your ability is $500. That is quite different than a pension fund, which might have billions of dollars behind them. If that firm had utter conviction in a stock, they might be able to buy the whole float. So, if Warren Buffett has conviction, that's what he's going to do, right? It's a different game. And this is where people get confused because they look at how some people play the game, and they don't understand that we play a little bit of a different game. But it really is about both the conviction of those buyers and sellers and their power, meaning basically the capital or the capital under leverage that they have behind them. We can sometimes, please notice the humility here. This is deliberate. If I was writing a scam book, I would tell you we can use patterns to find these hidden supply-demand imbalances. Sometimes we can, sometimes, and which means that sometimes we will see patterns that will also turn out to be bullshit. Sometimes the patterns, think about it, right? If the market is moving around randomly most of the time, that's my argument. And this means that sometimes the market is randomly going to make a pattern that looks just like a pattern that might be a high conviction pattern that shows an imbalance, right? So this tells me, if we can talk about type 1 and type 2 errors, this tells me that if I see a pattern in the market that is a strong indication of an imbalance, maybe, or maybe it's a bullshit pattern that just popped up out of the roiling noise of the market. So if you understand that, if you always understand that, and you always gut check yourself, then you will never go all in on a trade. Why? Because it might be bullshit. The pattern can fail for many different reasons. If we're trading patterns and we're not, that's also the reminder here, which is the next sub point. We're not really trading those patterns. What we're trading are the imbalances behind those patterns. And there's a chance that the pattern we see that we think points to an imbalance is just a random occurrence that doesn't even mean anything. And even if it is an imbalance that points to a buying and sell, even if it's a pattern that points to a legitimate imbalance, maybe that imbalance isn't going to last very long. It's one of the questions here. What's the duration of these imbalances? Can be instantaneous. We see, if we're short-term traders, we see imbalances that might last less than a second. We also see imbalances that might last months or years. I would argue that bubbles are imbalances that could potentially last for years. A cynic might say we might have generational imbalances. I don't know. I think that probably gets a little bit questionable, but this is very, very important to understand that what you're and this is why, if you hate me for telling you of an hour ago that markets usually move randomly, if you're upset about that, get over it, because here's the answer. If you accept that as the reality, then you understand that your job is to look for those moments when the market might be less than random. And if we do that, then sometimes maybe we can put on successful trades. These qualifiers are not me trying to speak out of both sides of my mouth. They're not me, using any kind of formal disclaimer. This is my thought process. Every time I look at a trade, this is it's like you have the little angel on your shoulder saying, remember, thou art mortal. It's the same thing as a trader. Remember, no matter how great this trade is, it might fail. If you always wrap your head around that, you will never go all in, and you'll be immune to a lot of the stupid things traders do. So why small traders can make money, this is also something I covered in the book, because you're not playing the same game. You're able to trade on time frames. You're able to trade on scales that are not interesting to these large institutions. And yes, there are sometimes distortions. And frankly, one of the things that Tom and I don't want to say struggle with, but laugh about and feel stupid about, is that we definitely did not capitalize on the crypto craze nor the meme stock moves to the I have no doubt that some of these 20-something kids on YouTube made quite a bit of money on meme stocks. So what I have found over the years is that there are these distortions in these situations where, if you approach them, so if you're a professional trader, what does that mean? So in my mind, it does not mean that I'm boring. It does not mean that I am some kind of stodgy institution that just does things according to certain rules. If I say professional trader, what it means is that I'm going to be doing this 10 years from now. I'm going to be doing it 20 years from now. I'm not going to blow up. I'm going to make pretty consistent money, as consistent as consistency in this business does not mean like getting a paycheck, but it means I'm going to be around, I'm going to be successful. If the market changes, I'm going to be able to adapt to those changes. I'm going to be a fucking player in the game. I'm not going to get blown out. If you approach it with that mindset, then the what you'll find is when some of the basically people who don't know anything will do better than you at some points in the market. Now, you get a room full of 1,000 of them. What it means is that a few of them got lucky and they will have eye-watering outperformance. Of course, what you don't see is the aggregate. You don't see the other 990 some who lost all of their money. So what I would actually argue is if you look at reasonable performance of the groups, the professionals are still outperforming in that moment. But you will see the people on Reddit who made $5 million on a $3,000 account by buying GameStop options, whatever. Those people do exist. However, I this is a competitive game. Okay, I don't mean to be a dick, but what my mind then says is I would encourage those people to continue trading in the markets because continue to trade, give me enough time, and I will take their money. Like, that's the mindset of the professional trader. And we certainly look at these events and we ask ourselves, what could we have done better? Should we have, taken some small accounts and YOLO'd them? Like, you think about things like that. Or would that have been a harmful break of discipline? And these are the kinds of, I don't want to give you the idea that you read this book and you have the answers to everything and you're going to be doing exactly the same thing in 30 years that you're doing today. I do think there has to be a process of evolution and growth, and part of that growth is painful. Failure is incredibly valuable, and failure is incredibly valuable because it shows us where we don't want to be, what we don't want to be doing. Of course, randomness makes that a little bit more complicated because we definitely have to untangle that piece. But it's worth spending some time thinking about the kinds of bubbles and distortions we've seen recently. And I don't mean the COVID move. So that the move that the markets, and I don't mean that the Fed-driven market movements, the QE supported decade-long bull market that's sort of maybe still going on. That's not what I'm talking about. I'm talking about like these special situation things, like the emergence of crypto, which is a whole new asset class, the power of social media to move stocks around, which is, by the way, anybody who was alive in the late 90s, we've seen this before, right? It's not exactly quite as new as people think. It's funny because nothing's really truly new. So how my chart reading has evolved. My indicator settings are currently in flux a little bit, and I advocated in the book for never changing your indicators. And what I put in the book, I had used with no changes, and I used for many, many years after. What I'm doing now, my current quest, I didn't probably should have put this up front, but we trade on many different time frames, and I have avoided for various reasons. I think maybe a central part of some of this book or some of these talks is going to be I have avoided trading index futures intraday for many, many years. And there have been many various good reasons for doing that. One was it interfered with a lot of other things. It is a huge commitment. You are, you're going to be glued to the screen pretty much every moment the market's open, and it's not really how I want to live my life. But I realized the more I thought about this, I can make a lot of excuses and a lot of good reasons for why I don't want to do this, but there was also a little bit of a challenge. There's also a little bit of my thinking that this is a very, very difficult way to trade, and markets have changed a little bit. I'm not 100% sure I could do it. And so over the past, since about the fourth quarter of last year, I've really been focusing on going back to trading the S&Ps and discovered that what I was doing in the early 2000s doesn't quite work for me in the same way. And I think, there's some reasons why, but I'm going through a little bit of an evolution, a little bit of a reassessment of not the core of my approach, but some details. And I am and started to write a few blogs about this, but one of the other things that I wanted out of this was I really wanted to, I think there's a great value in expertise. And I certainly have some degree of expertise, but I think there's also a lot of danger in expertise. And I think that it's very easy to get locked into a certain way of thinking. And what I really desired more than all, certainly I want to be successful in this venture, but I also wanted to get in touch with the beginner's mind again. I wanted to get into, I wanted to know what it was like to struggle. I wanted, it's been a long time since I've been a small beginning trader, and I think I remember what that's like, but I remember much more today what that's like than I did a year ago, because I myself have been putting myself through the struggles. And so part of that process is I'm reassessing my indicators a little bit. And the only the practical difference that I'm doing, I'm using slightly narrower Keltner channels. I'm replacing some exponential moving averages with, these are not important things, but I do want, in the interest of complete openness, I want to tell you that there are some things that I'm pushing around a little bit. And I've talked about some of these things with our Market Life members that, for instance, I've been assessing daily moves in a stock, looking at the percent change, the daily return, against a baseline of a standard deviation of returns. And that's a great way to look at things. And it's actually is the way that a lot of professional risk management systems do. Yes, it's a great way to do it, but I think I'm looking for an approach that is a little bit simpler and a little bit more intuitive, and so we're changing that, in the process of changing that, to rather than use the sigma spikes, I'm looking at the day's change in points, so the difference, not the percent, as a percentage of the average absolute change over a time window. I'm going to write more about that publicly. It's truly not important, but I do want to, one of the things I promised here is that I would tell you how my thinking has changed. James asked, is there any harm in choosing to use a logarithmic scale in all my charts rather than 2 instances mentioned in my book? So what I actually have tended to do in most cases is go the other way. If you use a log scale, and you draw a straight line, contemplate this. Imagine you have a log scale chart and you draw a trend line. What are you actually drawing? Think about that. What you're actually drawing is a curve, and on a linear scale chart, it would be a curve. And that should, again, if you're math comfortable, that should be immediately obvious. And that curve might make sense. I could actually make a very strong argument that that curved quote trend line is deliberate because it reflects the growth rate the market has accepted for the thing over a long time period. But I find myself more focused on linear trend expressions. So I am tending to use fixed or regular scale rather than log scale for brain just didn't produce a word there on all of my charts. So I would maybe lean that way. I'm also assessing a little bit more on focusing a little bit more on character of markets. That's always been a critical part of my thinking, but I'm using candlesticks. There is some overlap with, we'll talk about the word price action here in a moment. I still use the same patterns in the book. I do think that some stats in some markets have changed. I have not been able to fully articulate this, but for instance, one of the things that I would do as an intraday trader in the past is I would derive a bias for today based on how yesterday traded, and I think that's less valid than it was 10, 15, 20 years ago. And so we're working on untangling some of that. Here's just a quick glance. We don't need to spend a lot of time here. These are what my charts currently look like, and they're not much different than what you see in the book. I will point out this second chart. I realized when I literally just grabbed these off of a trading screen that was up when I did. This is an example of what bothers me. So I have this, and what bothers me are these session lines. I hate extra lines on charts. Now I need this on this particular chart. This sits in a matrix of like a 4 hour, a 60, and then there are other charts around it, and I just need to be able to see where the session breaks are. But if I had to look at this chart very much, these lines would be gone. I cannot deal with it. Also, one thing that I think is quite important, notice I have no horizontal grid lines. That's deliberate, because if you look at books where people do have horizontal grid lines, people talk, and then the people, this is an issue with some of the price action stuff out there. Any line you draw on a chart is going to look significant, and your brain is going to legitimately see price action around it. Like, look at this. If I extended this line back, it'd fall about there, right? Ooh, that's pretty good, right? And then we would go back here and we would say, check me with a ruler. I don't think I'm lining it up quite right, but look, like we had some up down action around there. Surely that's significant. And then look at this. So, maybe there's something to round numbers. I'll tell you, I've done statistical work and I haven't been able to really pull any out there, but I can't definitively say there's nothing there. But I don't want to be misled. I don't want to attach significance to some random fucking line on the chart. And then if more data comes in, think about what's going to happen. Maybe my 12-minute chart looks like this. And then if the volatility comes in and the chart rescales, instead of having grid lines, every 10, maybe they're going to be every 20, every 25, maybe every 5, right? So my grid lines can change by the end of the day. I just don't want to deal with it. So I don't have them on the chart. And I really am drawn to very simple, almost stark charts. I mean, you notice the presentation is red and black, right? I mean, isn't that a sexy color scheme? I think it is. So I do keep things pretty clean like this. I do use some bar charts, as you can see on the right. Let's talk a little bit about price action. So somebody asked, one of the questions was, where did this come from? Where did price action come from? I don't know. Of course, Al Brooks is a big name in price action, and if I'm recommending books, I would suggest reading his books. They're difficult to read. I think they're difficult to read because he has tried to, and as an author, I can relate to this. You have two choices as an author. Either you can try to, in the interest of complete honesty, you can put everything you know in a book. And the other side is to put what would be the most effective communication, which means you're leaving some stuff out and you're structuring differently. Al's gone with approach number one. That's why everybody thinks his books could. You read criticisms. People say, "Oh, this needed a better editor." I think what he's done is a complete download of everything that is in his brain about price action. And yeah, it's, no joke, his books are really difficult to read. But when people say price action, what Al does is he looks at the tiny little details of every bar. I think there's value in that. That's what price action means to a lot of people. Price action means a lot of different things. And when I wrote these down, I'd say Al is certainly in the bar by bar. I think he's used that in a couple titles, right? One of the things that I remember where I first started hearing a lot about price action, probably 2003, 2004. Some of you certainly have market memories and experiences that go back before mine. Send me an email and educate me if I'm missing something here. But there was a real push to, all the charting packages came out and you could slap like 1,000 indicators on your charts. And so then there was a backlash against that where people are like, I'm not putting anything on my chart. I'm going to trade naked. and there were some pretty horrific websites. people people took that a little bit literally and put up pictures of themselves sitting in front of computers that I do not want to see ever again. But that, and people became rabid about defining price action trading as meaning you're not using any indicators, not even a moving average. I don't think that's true either. People will talk about price action like you can buy these price action manuals today that will show you like stupid candlestick patterns, like engulfing patterns and whatever, and so you just look for these patterns. All of these are, the problem is like it's hard to define words, and this is what price action means to a lot of people. I use the example of the price action being the finger in the sand. Imagine that you go to the beach and you're drawing in the sand. So market structure is the line you draw. This is in the book. That's what market structure is where price is been. But price action is how your finger moves. Are you like jerky? Are you smooth? Are you using a lot of pressure? Are you just, are you changing pressure? And so price action to me is how we're getting from one level to the other. And again, this represents the power of buyers and sellers. There's absolutely some overlap with tape reading. I do not use an order book. I do not look at a time and sales. I don't have a depth of market up, but when I look at a short-term chart, what I'm seeing is a lot of the information that somebody would see there. I don't think there's a lot of value, and I can say this after spending years of looking at depth of market. And, again, maybe I missed something. Maybe there are analytical tools that can pull stuff out that I'm not aware of. So I certainly don't want to say that I have all of the answers, but I do think that I get all of the information I need from watching how a short-term chart moves. And so that's what I mean by price action. Now, in the evolution of my thinking, I do think we can capture some of this in candlestick patterns, and this lines me up maybe a little bit more with the approach that Al Brooks advocates for. There are some other price action authors that are maybe a little bit easier to understand. You certainly can Google price action books or discussions online, but I would avoid their. It's hard, right? I mean, it's hard to understand what good trading information is. The two forces. I just want to highlight this because I was reading the book and I was like, oh, come on, Adam. So I talked about a motive and resistive force. Really, this was kind of for those of you who are musicians, which is probably one or two of you. There's a set of Beethoven wrote a set of variations for the piano in C minor, kind of a famous set of variations, and they're a little bit ridiculous. He basically like captured every technical aspect of the time in this weird set of pieces. And there's a story of somebody playing it for him late in his life before he lost his hearing, and he was just like, come on, Ludwig, like he was making fun of younger him who wrote something that he apparently thought was kind of silly later in life. And that's how I feel, frankly, about saying motive and resistive force. I don't know what I was doing. In presentations, this grew out of primarily presentations to institutional clients who were wanting to understand how markets moved. I found myself thinking, because these are factors that they understood, these are portfolio factors, momentum, which is the tendency of a market to make a move in a direction and then to continue to move, and then mean reversion, which in the same direction. Mean reversion is the tendency for a market to make a movement and then to move back against it. Now, the issue is, these are two, let me draw on the screen, these are two exactly conflicting things, right? So if you have a momentum move, a market makes a move, the momentum move is the continuation. Mean reversion, market makes a move, and then the mean reverting move is to the downside. If you were able to separate these two with 100% score, you'd never have a losing trade. This is the entire problem of trading, is knowing it. You can summarize it in knowing when a market makes a move, which of these forces is likely to win in the future. And this is a slight evolution of my thinking from what was in the book. And this is many of the patterns many of the trade management techniques are really designed to drive to answering this question. Now, you can't do it 100% of the time. I don't even have to tell you why. I shouldn't have to tell you why. But what we can do, we can find patterns, we can find conditions that tell us one of these forces is more likely to win than the others. So that's something that's changed a little bit in my thinking. It's a lot of talk in the book about pivots, and I also did a free trading course, which, for those of you who are developing traders, there's a couple free trading courses that I've done out there. It's a very short one that's recent, and then there's one that's like, I don't know, what is it, 36 hours of video that really works quite closely with the book. And there's a lot of work on pivots in that one. So what I did this slide, and then Manik sent me a question. Here's a question, I'll read it. One question about third order pivots. Do you use those formally or intuitively to help with entries trade management, for instance, when trading pullbacks? So I got that question after I made this slide. I didn't change a thing on the slide. So do you need to understand pivots? Yes, intuitively. I don't, however, think you can trade them as is. Some people argue you can. So maybe I'm missing something. I don't think you can. And just to highlight, these are the third order pivots. This was also in the presentation before I got the questions on the topic. And what I think is more important than actually going through, these pivots are correctly marked. So here's a third order pivot down, here's a pivot up, and it's definitely worth remembering if you want to think about these systematically. This is not one, but pretend it is. It could be, right? If the market structure were a little bit different, you can have three, you do actually have two, but you can have three third order pivots or even more in a row. There's nothing that says these guys have to alternate in really nice patterns like that. Rather than what I would encourage you to be able to do is to be able to draw some kind of intuitive structure. And I'm drawing on the screen and not drawing very well. And we could have a debate like that last bit I drew. Should it be that, or should it, it really, you want to be consistent. I think it's worth taking a lot of time to be able to pull this structure out. But what is more important than being able to do it in a specific way from pivots is to get to the point where you see these swings. However, I don't think, maybe I'm wrong, I've never seen anybody do it where you can get to the point you're consistent with these swings that you aren't, if you don't go through the process of using pivots. So it's a valuable training tool. There's some more questions here. Using and plotting, Woody asked, by using and plotting pivot points, can we clearly distinguish trends and consolidation patterns? Sometimes, usually, not always clearly. Is the use of third order pivot points more suitable for common market conditions? Well, yes. Look at the obvious points that jump off of the chart. Spend a few days doing some very rigorous pivot point analysis, and then remove some of the rigor, but keep the insight you got from that. I think that's the way to treat the exercise. Somebody says, the more third order pivots on a chart, this is a question, the more likely market remains range bound as it attempts to secure a foothold in supply and demand. He's wondering if that's an issue. It's something he notices intraday. It's an interesting point. I certainly have done various kinds of analysis, like pulling out number of pivots, number of turns. There are other ways to quantify this than just pivots, to look at like a ATR move off of a swing point. I can look at different kinds of market structure in there. I think you're on track. I think you're thinking in the right way, and there's probably some truth to what you're thinking. What I focus on now really is length and character of swing, and candlesticks are important. We'll look at a couple examples here. I'm focusing more and more on rejections. And this is, and what I mean by rejections, I was focusing in the book, right? The first actual trading pattern in the book is the failure test, which is a rejection. And that is a pattern that I still use, focusing more on both where you have a single candle. Let me give you an example that might have a small body, some kind of hammer or inverted hammer as they call it, or also the possibility of having what I would call a reversal complex, which might be, just pretend this candle is red, and then beside it is kind of an equal-ish candle, or sometimes it's a series of three. And it's not so much about candlestick patterns. We'll get to that in a moment. But both of these kinds of reversals, I think, are very, very important. I'm also focusing very heavily on the 50% level of a swing. And what I mean is, so a market makes a move down, then what we're going to do is to assess approximately the 50% level. Now, what this does not mean is if the market goes to 51%, oh, it's then our thinking changes. No, this is a big fuzzy area. Practically, it's really here, but it's more like 25 to 75. These are not Fibonacci numbers. And I don't use Fibonacci, and for it's a discussion for later, but there's very good reason for that. But what it means is that if we're able to rally up to the 50% level, now you've got my attention. I'm thinking that that we're going to be in a momentum mode and we're going to have maybe a pullback to the downside. But if we get up to this 50% level, I'm thinking maybe not, right? And then if we spend much time like above that 50% level, the probability of this nice easy sell-off starts to get a little bit lower. So what I'm using is, this is a subjective evaluation point, but it's a real thing. Let's look at a few examples. Let's look first of all at this 50% rule. So look here. You got to swing down here, and I'm going to draw a lot of lines and erase a lot of lines. So I was aware at the time that we bounced up that, and I'm not going to draw exactly on the screen. Why? Because I'm incapable. I can't do it, but I'll do my best. We bounced a little bit above, but there was really no conviction there. And then so this is an example of a pretty clear pullback to the downside. Here's next big swing down. So now I'm evaluating the 50% level, which is right there. We never got there. Just a couple other examples. So it's obvious. So then when you're looking at this swing, two ways to look at it. You're looking at this swing and you're looking at the 50%. That's not right. I can't erase a single line. 50% level, something like here, right? So we're flirting with it here. But you're also aware when you're at this point that you're looking at the big level, the big swing down too. So you're kind of aware of the nesting of those. This is, for instance, when you get look here. So here's an upswing, and this is the first upswing with much real character. How did we address the 50% level there? No question, right? So this shows you that, not that you, after this day, not that you would have been thinking very much about buying, but, the fact that we knifed through it tells you a lot about the market character. Now, are these tradable? Not necessarily as is, but sometimes you do get very useful information here. Here's another case. Look at this swing. First, we'll swing up off the bottom. Now, let's think about this swing in two ways. First of all, this is the swing we're talking about, okay? So first of all, we are assessing this swing based on this move. And where's the 50% level-ish, right? So this is a point where we would naturally look to see, we really couldn't get above there. So this is a reasonable spot to think you might have a short. And this is a reasonable, and yeah, it's not possible. I know I'm jumping around a lot. I'm assuming a lot of knowledge here and even talking about these trade setups because we haven't talked about it. I can't do this in a perfectly linear way where you're gonna have to put these pieces together going through the whole presentation, which will take weeks, I know. But so that's one way to think about it. However, let's look now at this swing, and where's the 50% level of that swing? It's here, right? Look what happens here. What do we get? Start to get a lot of tails, right? We start to get a lot of price rejection. And then we come back to this area where we had price rejection. What do we have? More price rejection. Now, let me tell you, you're looking at this and you should be suspicious because what you should be thinking is, this guy's showing me a chart and he's looking in the middle of the damn chart, and he's drawing lines, and he's telling me how smart it would have been to make trades there. You should be suspicious. So one of the best things, and Tom actually did this for me when we set up Market Life many years ago. There's now a daily archive. Every single day I record a video giving my read on the market and discussing things like this. So I can go back. Anybody can go back. We never delete anything, right or wrong. I can go back and see what I was thinking at the time. And this particular case, this was something that I do remember distinctly we were aware of at the time. So a lot, anytime anybody's analyzing past data, you have to be suspicious that they might be putting it in a little bit better light than, or, some wishful thinking. And you even need to be careful. What's the saying? Believe nothing you read, nothing anybody tells you, and only like half of what you think you figured out yourself. You also need to be careful. It's very easy to have a cognitive bias where you remember yourself being better than you were, or you remember something being more clear than it was. This is the value of keeping some kinds of records. So it's also a very good thing for me to be able to go back. It's an accountability thing because all of my analysis is out there forever for anybody, but it's also good for me so I can go back and check my thinking and see what I missed. And it's a very, very good thing. And I would encourage you to replicate something like that for yourself, whether you're journaling or recording a short audio clip. You got to do it every day. You have to be very, very disciplined with it. The other thing that I would certainly be aware of and focus on here would be these long tails here and here, and some of them do, these are not necessarily actionable things. This is an example of what I would call a reversal complex, a great bar up followed by a great bar down. This is conceivably sort of the same thing over 3 bars. This is what I would say that's not very nice, right? So what this is the second bar of this is a nice reversal signal to the downside, and then a complete reversal of that to the upside. This happens actually quite frequently. It typically happens in consolidation, but these are the kinds of points that I was maybe not articulating quite so clearly in the book. And then, of course, we're talking about these areas here, but it's also very important, I think. And if we were just speaking about Al Brooks, if I had to boil his work down into the most significant thing, I think the most useful thing, immediately useful thing for most traders, I think it is, and when I reread his books a couple years ago, I found that my thinking had evolved to align completely with his on this point, but assessing the conviction by, and this is also in my book. I wrote about this, but it wasn't quite as important in my thinking as it is now. Assessing the, here the bears were very, very much in charge because you have all of these bearish candles with almost no bottom wicks, so there's no lift on the bottom, and here's a period where the bulls are pretty clearly in control, and you can refine this a lot. And again, there's quite a bit of noise, so there's quite a bit of bullshit. There's quite a bit of the market lying to you. And somebody asked, I saw a question, what would I say? There are people who say the market is completely predictable. Well, then those people should never have a fucking losing trade, right? I don't understand that. I don't understand how you can have authors and gurus very publicly saying the market is completely predictable, that and there are people who actually fall on completely the radical other side of my randomness argument and say that there's zero randomness in the market. Everything is completely deterministic. I'd like to see what they say when we get further along in this presentation, because I have a bombshell today. But there is a degree of noise, and not everything you see is meaningful, but overall you use this to build a sense of the character of the market. And then yes, you still need very clear points at which you will execute, but so there is a difference between this type of contextual character assessment and then where you actually move in and out of trades. But I think this is really, really important. I had two charts here. I don't think we need to spend much time on this because we covered the ideas. So let's take a little bit of a break here again. Let's take exactly a 5-minute break. I will see you back in 5 minutes, and then we'll get into something really interesting. Okay, and we are almost back. Yeah, we're back. So let's jump into this. We also should talk a little bit about probability before we're done here. But okay, so this is in the book, and I do think that one of the skills we should think about. This obviously dovetails very closely with what I was just talking about, with being able to assess the character of the bars. For instance, if you go back and if you look at a bar, let's see. So look at that bar and compare that to this bar, okay? So this is bar number 2 and this is bar number 1. So it's pretty clear that probably bar number 1 here, which I'm sorry, it's on the right side of the chart, but whatever. Uh, bar number 1 shows more conviction, right? The range is bigger. The close is near more bullish conviction. The close is near the high. Bar 2, it's kind of a sad range bar, and it closed in the bottom half of its range. When we're assessing the character of the market by reading the bars, what we're actually doing, we're making a lot of assumptions. And these assumptions in the aggregate are probably pretty good, but this is an illustration straight out of the book. You have this nice big up candle here, and you might assume that this is what happened, right? But all of these other things are possibilities, and in fact, there are a lot of other even sillier possibilities. It is possible that the market started here and then like traded right up at this high, and then right before the close did something like that. That's not very likely, but there are all kinds of crazy, crazy possibilities. And this is something that I think there's a right degree of overthinking. So if you overthink too far, you're going to get into this paralysis by analysis. You're going to never be able to accept or trust anything you see. And again, I have a bombshell coming in just a moment. But if you don't do any of this thinking and you just accept the bars at face value, I think you're missing an important part of the picture. And we can skip over this because we've covered this already. So again, how my thinking has evolved. I do focus a little bit more on wicks. You will hear me say with pretty much equal probability, I'll say shadows or tails to candles. I might even be looking at a bar chart and talk about wicks. I don't know, but it's the idea of the wickiness of the action that matters. Kind of a corollary to that is that shaved bars are important, and a shaved bar means a bar that has no tail. So for now, technically, is there a shaved bar here? And what I'm talking about really is in the direction of the bar. So this bar is nearly shaved on the bottom, but it's a bullish bar. So the business end, if you will, is this actually is shaved on the bottom. But that's not what I'm looking at. I'm looking at the trendward direction. I'm also finding myself, by the way, saying trendward and leeward. Thank you. Um, a little This bar for practical purposes is a shaved bar to me. So it has a very, very small wick. And if we understand, and the last bar on the chart, the very last bar on the chart is also shaved. If we understand that the wick shows rejection, the absence of that wick shows conviction. And again, this is not necessarily directly actionable because my eye is drawn to, I'm looking for my mouse here, my eye is drawn to this. This is nearly shaved. How much downside follow through do we have? None, right? So it's not that necessarily you see this and it's 100% the outcome you expect, but it does tell you something about the market character and in aggregate. I also already covered this, reversal complexes. I'm particularly sensitive to patterns that show the emergence of momentum and the buildup of buying and selling pressure in ranges, and we'll talk about this. So can we depend on price bar formations? This is one of the major points of debate. When my book came out, and I started to do a lot of consulting with institutions, and a lot of these people had a lot of CFAs and MBAs, and people who thought that, frankly, looking at charts was a stupid thing to do. I mean, had several people tell me that. Well, I read your book, but there's a lot of charts. These people obviously think there's no information in charts, and even within technical traders, you have this very big divide where some people will say every single tick matters, every slight formation, every slight difference of formation is information from the market. And some of the authors that we were talking about a moment ago believe this. On the other side, me, uh, people say the market tends to be pretty random most of the time, and that everything we see on the chart we have to be a little suspicious about because there's a high degree of randomness. How do we resolve this? Here's how. This is totally new. This is not in the book. What is a price bar? A price bar is I'll tell you how I figured this out finally. Me and Tom arguing for months about about issues, trading issues. It's very helpful to have somebody that you can argue with. My belief today is that a price bar is a statistically valid sampling technique. Now, does a sample accurately reflect a population? Not necessarily. For instance, okay, my brain's a little strange. It's stranger than you might imagine. But several years ago, my wife and I, we went to Mexico City, and I randomly had the thought that if really stupid aliens were to abduct us from Mexico City as a random sample, they might come to the conclusion that most of the people in Mexico City were white people who were born in the middle of farmland in America. And obviously, what's the mistake there? I don't know why my brain supplied that. The mistake there is they would have taken a very small sample, and in getting a very small sample, they would not have had a representative sample. So how do we how can we be pretty sure that a sample accurately reflects a population? That's what we want, right? We can't, if we're those aliens, we don't want to take every single person from Mexico City and count them all. That's not a sample, that's everybody. What we'd like to do is get a handful and look at those people and say, oh, I think everybody there, this like these proportions represent the population. So one of the answers is if we can sample often, so we can sample over and over. And with price bars, we certainly do. And if the sample is large enough, and this is, we kind of arrive at the same thing. And so this is why, I realized that intuitively over the years, as I have gravitated toward this, the approach that I'm advocating of, yes, looking at the details of the price bars, looking at the details of the formation, trying to understand what specific formations, what these things might be telling you, but then to be pretty suspicious of everything you're looking at. That's what you're doing, is you're allowing for variations in the sample and understanding that sometimes it might not be representative. But at the end of the day, what a price bar actually is, you're going in and you're grabbing random prices. Now, are they random? Not necessarily. I think those of us who, if you trade 5-minute bars, you will notice intraday, you'll notice that there are some activity bursts at the end of those 5-minute bars. Maybe it's a 5-minute bar thing. Maybe I'd see the same thing with 3-minute bars. You would, by the way. Maybe it's that those 5-minute bars also end at like 10 o'clock or 9:30, right? Or 4 o'clock, 8:30 in the morning. I'm all talking New York time when, when economic reports are released. Obviously, if we're using daily bars, those closes are not random samples, they're settlement prices. But, if we're using tick bars or volume bars or something, we are using essentially random samples. So if they're even if they're not quite random samples, I think it's appropriate enough to think that they are. They're certainly valid samples, and therefore I think it is completely reasonable to assume that price bar patterns reflect underlying market dynamics. They say something real, they say something useful, but details are suspect. So let's look at a few things here. Look at this price action on your screen. This is the intraday S&P from the 21st of last month. I want to look at this. We're going to look at this several ways. If this, and I have to go kind of fast because we're going to look at a lot of data here, multiple ways, and you may want to watch some of this on replay. So first, let's just kind of get the lay of the land here. Here's what I see. Here are the points that I want to investigate. I picked this specifically because we have a number of turning points, and I'm going to use different colors here. So the red points, these are turning points. And I would characterize this first one as I'm going to be careful what I write on the chart. This first one is kind of a reversal bar complex, right? There is a tail. Look, so there's a little bit of a tail in this bar that I'll use a pointer here. So there's a little bit of a tail here. There's very small tail here, and then there's a much bigger tail here. So this might suggest to us we're running out of momentum. This is followed. How clear is this? Not very. How clear is it now? Very, right? Because now we have a bull bar. So the momentum is completely shifted to the upside. This is a 2-bar reversal complex on the bottom. Here we have a 1-bar. This is not really technically a doji for the candlestick people, but I don't care about that. I don't want to get deep in the weeds, but all of these labeled candlestick patterns that people like to talk about and talk about the cool names, they don't test out statistically. Many of the people who are advocates for those have admitted publicly that they do not trade, that they instead act as consultants teaching people how to read candlesticks, and I have not been able to trade them. I've not been able to find a statistical edge. So I think if you are approaching this with the idea and this being the trading problem, that you're going to have like these candle patterns that you're going to trade, I think you're wasting your time. I think you're in very perilous waters. But what this candle shows us is that there was price rejection, right? There's actually 3 candles here in a row that show price rejection. There's no interest in closing above this level. This is a kind of reversal. Here's a single bar reversal down at the bottom. And yes, you can attach a candlestick name to that, but I don't care. I think you're wasting your time. Let's look at a few other reversal points. Here is a reversal point. So we also have here a sense of contracting swings, right? Here, there's some reversals here. I don't want to get too sidetracked here. I want to point out a few more things. We'll come back to this chart. That's why I'm going so carefully with the colors. Look here. We have what I would take to be evidence of probably a large order in the market. We have a number of bars that have precisely the same high. So this is a little bit of a held offer, we would call it in the language of tape reading. Here we have a shift in character here. This is where the market has a number of bullish candles in a row. If you had a little bit of that here, we also should look at this area. And we had a bit of a broadening formation, which might or might not be significant here. And at the close of this, as you can see, it turned out to not happen. But I would read probably the right side of this chart as being potentially pretty bullish. I was trading this day, so I do remember my assessment. I think it was reasonable to look. I had a long trade there that didn't work out. You also had a reversal complex here. So with that in mind, we're going to be coming back to this slide a few times. Here is the same slide, and let's look first of all at these reversal points. So I have now, what I've done is, let's just look at these first 3 reversals. I'm now going to show you on some other slides, this is the same data, because one of the questions when Tom and I were arguing, Tom was like, well, you see these patterns, right? You see that doji, you see that shaved bar, you see that reversal complex. what would you have seen if the timestamp was 1 second different? Well, here's what you would have seen. Let's look at the same points. You would have seen essentially the same thing, Now, we shouldn't be shocked, right? This is a 1 second difference. Let's go forward. Here's an offset of 3 seconds and 6 seconds. I'm going to flip back and forth between, I'm going to highlight these just to, actually, I don't think I need to. Let's go back and forth between these slides here for a moment and just kind of take your eye and look at the points as they change. What I want you to see is that now with the 6 second offset, and I'm actually going to go forward to a bigger offset, here are 8 and 11 seconds. So still, just focus on these highlighted points here. And I'm going to stop and show you a few things. So look here. Here we start to lose, here we have this nice kind of doji-ish thing, right? If you look at that, here it starts to devolve, if you will, into a bigger, maybe a bit sloppier reversal complex. So again, what this is, these are all 5-minute bars, but I've moved the beginning and the end of each bar by an artificial offset of 5 seconds. What if the offset is even bigger? Here's an offset of 45 seconds. Now, we still see, that's not very nice, we still see the same types of points, but the specific patterns are a little bit different. Here's an offset of 1 minute. Here are 5-minute bars, offset 1 minute. And look, if you compare, look at this first point, this candle is completely different. The body color is completely different, right? But the point here is that all of these things that if you were a candlestick person, you would identify. Here's the same thing. I promise, this is the last set of offsets for this one. Now look at what's happened up here. Here's the offset of a little bit more than 2 minutes. Here's even bigger. These patterns have completely changed. So I would suggest, if you are anchoring your execution to the specific details of these candlestick patterns, you have an approach that is not rooted in reality. For instance, some people might look at these candles. Look at the 1 minute chart here. Hold on. I have a hate-hate relationship with PowerPoint, but let me get to the pointer. Look here. So the bodies of these candles are exactly the same. Some people would say that's a good buy point. And really what it has to do with is the way that the way the market opened and then did not trade down below that open. But of course, you see these are exactly the same points, and they're quite different in details. It is interesting though, and you're going to have these slides. Somebody asked if you had the slides. We'll get the slides to you. What you're going to find is that the impression. Look here. That totally changes. And here is I'll tell you another thing at the end, how I got to this revelation. Here, this has evolved into a 3-bar reversal complex. So this is why when I tell you that I'm focusing on tails. So here's a tail and reversal complexes. Here's a 3-bar reversal complex. It's the same thing. In this case, it is literally exactly the same point in the market. And I refuse to believe that if you believe that every detail of a chart is significant, then you would believe that these are very different pictures. Let's forget that the outcomes of the patterns were the same. But if you understand that all you're dealing with here is kind of a rough and tumble statistical sampling technique, then you start to see, oh, okay, so this makes sense. Let's look at a couple other things. My argument here is that this is all much more constructive than we might think it is. I'm not saying that that this invalidates anything. It's actually exactly the opposite. I think this is a resounding support of chart reading. Let's look at this little held price here. We don't need to spend a lot of time with this, but just look through each of the charts and you will see that even with the offsets, that information is preserved. When we get to some of the bigger offsets and things have shifted enough that it is lost here. So, again, there was, if you happen to be looking here, you would not have seen quite the same picture there. This argues against an approach looking at details. Let's go back here and let's look at where did this get very clearly bullish here, right? These two green arrows I've drawn. I don't think the first one is particularly bullish. We couldn't really get very far away from the moving average. There are a lot of upper tails, but let's also look at that. And then let's see, the question I have here is, in this area where I argued we got pretty clearly bullish, do we see that on all time frames? And just to orient yourself, so we're talking about here, let me erase all these lines. We're talking about here, and to some extent, not so much here. The 1 second offset is almost exactly the same picture, pretty much the same picture. This 11-second offset, this might look a little bit more bullish to my eye. It's a subjective evaluation. Pretty much the same picture here. 60-second offset, I think I would read this more bullish, but in fairness, I don't have a moving average here on these charts. This is still pretty clearly bullish, and in fact, the offset here, we've revealed a little bit of structure that was missing. What I mean by structure is that there was a little bit of a retracement in there. So let's look at a couple more of these. This is the visualization that I said really snaps all of this together. Somebody said, what's the meaning of offset? Okay, so what I mean by offset here is that these are 5-minute bars. These are standard 5-minute bars from the exchange, but depending on your data feed, you might see slightly different 5-minute bars. What I have done is I've taken these 5-minute bars and I've just said, what if the bar started 1 second later? That's what the offset is. I've just, we still have 5-minute bars, but boop, we just move them forward in time 1 second or more. So let's look here, and we won't spend quite so much time here, but there are some trading patterns here. So look, this is a very bullish phase that then goes into a sideways trend sideways range. That range was signaled by a failed breakout to the upside, and we ended the day with a reversal complex. On the way up, we had very tradable structure. We had a pullback here. We had the upside breakout was perhaps signaled by this tail. I don't really care that it happened at the moving average. We had a little bit of an inside bar, 1 bar high and tight pullback. We had a very nice pullback here. And so let's see how much of the structure is preserved. What's the easiest way for me to do this? I should have marked it here. Let me just mark these points here. I'll flip through the slides. I'll flip through several times just like before. And what I'll count on you to do is to look at these points that I've marked here on the offset charts. So these offer, again, they're different in details. Look at, let me go to the laser pointer. Look here. So look at this little inside bar. This is a tradable pattern. When you have this is actually tradable too. When you have a market that has a strong thrust and then has a small bar that consolidates near the high, you can trade that for an upside breakout. 1 second offset, this looks different. These are the same pattern. So if you are treating these, if you would see these in your trading rule set and you would treat these differently, fine, but just know that your approach isn't rooted in reality. And that's a discussion for later. Look here, a little bit different. Maybe you don't even see it so clearly here with a 7-second offset. Here's a 30-second offset and a 12-second offset. We still have the inside bar, but these look different, but they're still materially the same. Here's a 2-minute offset and a 1-minute offset. I'm just going to flip back and forth between all of these, and you can just kind of keep your eye in the same place as I do that, and just look at the shifts of the patterns. And when you have the slides or the playback, it might be beneficial to, yeah, honestly, it was a little bit of laziness that I have never generated this type of work before. It wasn't incredibly difficult to do, but now that I have done it, I made it harder than it had to be. Now that it's the story of my life. Now that I have done it, I'm spending quite a bit of time looking at this, and it's making me at this advanced stage in my life reconsider the way I think about some of these patterns. Let's look at one more point here. I'm going to erase these lines, and now I want to call your attention to these reversal points. So here's a bar with a clear tail to the upside. So this shows rejection above the high of the day. And then here's a 2-bar reversal complex. This happened right at the end of the day, so we don't get any follow through from it. There's really not a lot we can talk about there, but let's flip through the offsets and look. And notice that, this bar looks quite a bit more bearish than this bar. It's the same damn thing, right? So the price action that generated these things, I guess what I'm thinking about is, let me put this another way if you're struggling with it. There is this like underlying stream of market data. Sybil says, I don't understand the point of the offset. It's not a true reflection of the market. There's no offset in reality. Well, what are you talking about? That's exactly the point. What is the market data? The market data is just like buying and selling, right? If you want to argue that maybe there's something magical about the end of the 5-minute bar, that's exactly the point I'm arguing against. Because if I have a data feed and you have a data feed, we might have slightly different 5-minute bars. And so what I'm doing here is just showing like, hey, if the bar had been a little bit different and we were chopping up, there's this market action that's going on, right? There's the like tick level buying and selling data, and all we're doing to create the price bars is going in there and like grabbing random samples. And what I'm showing you is, I think, incredibly valuable, that if those random samples were taken out of the market at different points, we're still going to see substantially the same picture of market character and market. I have to be careful with price action because, as we've said, that word means different things to different people. And if you are thinking that price action means like these precise candlestick patterns that you trade around, you're seeing different. You're seeing quite different precise formations, but it is reflecting the same underlying thing in the market. Part of this is market structure. Like if you're asking like, what do I mean about different data feeds? I mean that like you could have a different data provider, and it's not the way you get data onto your screen is not quite as simple. It's like there's some like reality data stream that flows into your program. Things are filtered, they're massaged, and charts will look different from different data providers just because the feed is different. Look here. So here's an offset. This is quite a large offset. This is a 2-minute offset, and that nice candle rejection we had up there is now turned into something that's not quite so clear, right? But this is still the same exact market action that generated this very clear rejection, also generated this thing. So would you, I mean, to be perfectly honest, you give me this and that reads to me as a potentially valid breakout. I would be potentially willing, all other things being equal, this particular case not, but I would be interested in taking a breakout trade above the high of that bar, while I never would do so here. And I certainly would not do so here. But what I'm pointing out is that we are potentially being misled by this is, if you think about all the ways patterns can mislead you, this is one way that we can be misled. And I don't think we can eliminate this weakness 100%. It's like you're an old time knight on a horse. There's going to be some weak points in your armor. There's going to be a place that a guy can get a little thin sword. There's going to be a place where it has to be articulated so you can move, right? We have to have some chinks in the armor. There are going to be some weak points. You hit a tank from directly overhead. It's different than hitting it head on. But what we can do is make sure that there are as few of these vulnerabilities in our thought process and in our trading process as possible. And I think that understanding what happens if you just shift the bars just a little bit, if you were to just sample a little bit differently, how different the market might look. And critically, actually maybe a more valuable thing than that is what does not change. Because as I've been flipping through these charts, I'll do that again here. What you should also notice is that a lot of this does not change. These things are telling you substantially the same picture with these different offsets, and that to me argues for the validity of using a price bar and pattern-based approach, but does definitely point out, I mean, like, look right here. You're going to think about buying over that? Never. Buying over that? Never. But the same price action that produced this, and I would think about buying over that. So you're not going to be able to fix all of these things, but what this will prevent you from doing is getting too attached to the beginner's vulnerability of thinking, I see this pattern, it's going to work out, it must work out, and then you do things like ignore your stops, or you add to trades. Somebody says, instead of offset, can I think of an obscure time frame like 6 minute or even trivial? Who cares? Like, yes, I mean, of course, you can look at any time frame. You can look at tick bars, you can look at volume bars, you can look at range bars, use whatever you want. That's immediately and easily understood by everybody. But I think this offset thing is new. Like, there's no easy way to do that. Somebody I saw earlier asked if I looked at say a 15-minute chart, would we see more stable patterns? And I have played with this on many different time frames, and what I'm seeing looks the same with whatever time frame. I'm kind of curious to mess with daily data and see what happens if instead of the close, but that's a separate thing. Let's do one more. And this one's really subtle. And if you were just arguing with me, and I encourage you to argue with me, by the way, like, it's fine. I'm not at all upset. This is much more subjective and much more room for disagreement, but I picked this specifically. So this is accumulation. I think, based on what we were seeing in the morning, and again, I traded this, so I'm not making this up, it was reasonable to see that we were building strength for a potential afternoon trend. As I don't want to go all the way back, but one of the charts I said I thought that we were also setting up. It didn't work out. In this case, it did work out. What were the points that argued for accumulation? In my opinion, look at all of these tails right off of the open. Look at the fact that we broke above the opening range with good momentum. This candle's arguably a little bit bullish. Then we settled into a sideways range. There was nothing particularly bearish here. Every selling pressure here met by tails and a big upside reversal. Oops, big downside reversal. Oops, big up, right? The bears never really can get in control. 3 bearish bars in a row. Really? Not really, right? You have those lower tails again. So here is really probably the best selling pressure we saw of the day. And by the way, that's quite typical that just before the market does one thing, it does the other thing, because the market's going to try to screw the most people it can. And then that was followed by a reversal. Now, this is not terribly impressive follow through. Tight consolidation, upside break. Let's look at this with offsets. So first of all, look at the wicks in the morning. Just we'll flip through this several times. I have several offsets. You know how this works now. Look at the wicks in the morning. They're preserved, right? However, so what this would tell me is, if you would read, let's just use this chart. If you would read this differently than this, you're doing something that's inconsistent. Okay, so because this is the same area. Now, would you have been willing to think about shorting under that shaved bar to the downside? Maybe, So this is a case where I'm not saying that you're going to eliminate every losing trade, but what I am telling you is that the price action that produces this candlestick formation and this candlestick formation are essentially the same. Here's a nice bullish candle to the upside, which we don't really have quite so much in some of the others with these different offsets. Let's look at this bullish run. Is this bullish in all of them? Quite clearly, right? No surprise there. Let's, I don't want to get too much into the dynamics of the range because I think there's a lot to read there, but just look, do you see, let's look at each of these offsets and look for something that looks more convincingly bearish, okay? What I'm looking for here are areas where we might have been misled. This is with a 1 second offset. That's kind of a bearish bar. More, not really. But there's nothing here that's substantially different, right? This maybe 15-second offset maybe is a little bit different. See all the wicks here. So you have to read, this is quite different, right? Up, down, up, down, up, down, up, down. Nice big tails here. So this is why, rather than having specific patterns, this is why you have to have, this is why I think it's better to have tools where you assess the character. Okay, so that is all I have on that. I think that this last thing that I showed you with these offsets, I think this is very important. This is something I just stumbled across a couple days ago. I sort of had it in my head, and I kind of I was pleased that, I spent some time visualizing, like, what do I think these offsets would look like? And I had a pretty good expectation, which I'm pleased to be able to come back to you and report those did line up with reality. What I thought I was seeing turned out to be what I thought it would look like is what it looked like. But I wasn't able to show other people, and I didn't really know. I was guessing that my massive powers of visualization were correct. I didn't know. Now I know. So what I want to do here, I do have one more section of the presentation, but there've been a bunch of questions, and I told you you could argue with me, and I ignored your questions. So let's do a little bit of Q&A, and I might do a little bit of Q&A that wraps back to the first part, and then we'll take a little break, and I'll come back and I'll do the last part of the presentation wrap up. Let's see. I'm just going to read through these here. Can it potentially be pumping up? Of course, like, and it might work out for not other reasons. Good. I should read these. Offset proves imbalances do indeed lead a footprint. Okay, you know what? That's actually the point. Thank you. This is why I like to share ideas with people, because somebody will invariably say what I've been, I've kind of been like stumbling around the edge of the campfire and getting burnt, not really saying it clearly, and then Mark just types it in the chat. I do think the offset proves that imbalances do indeed leave a footprint, regardless of how one chooses to represent the market. That's it. Thank you. I'm going to steal that because you're right. I'm making the argument of Wyckoff versus Schabacher, basically, versus specific patterns. I guess Wyckoff is the way to go. Yeah, it's not really Wyckoff. One of the things that I think I might do at some point in the future is to kind of revamp the Wyckoff material, which is public domain, and bring it up to, I think I can bring it to the modern era in a way that hasn't quite been done yet. But what's more important than Wyckoff is, so Wyckoff was, for those of you who don't know, kind of a tragic story. He killed himself like Livermore in his 30s, I think. Before that point, though, he had amassed a considerable fortune trading. He taught publicly through a correspondence course. He was a day trader, like literally a tape reader, reading the ticker tape. His entire approach was based on sort of personifying the forces of buying and selling pressure in the market by thinking about big forces, and there were big aggregate groups just as there are today. But this is where this idea that I advocate, thinking about the balance of buyers and sellers, this really goes back to Wyckoff's thinking. And yeah, that's what I'm showing you, that no matter how we mess with this representation, and look, you could make really weird bars, right? I bet if you had like, let's say you had a system instead of a 5-minute bar. This is basically what a tick bar is, but what if you had like a 5-minute bar and then the next bar is a random length, and maybe it's 3 minutes and 30 seconds, the next was 6 minutes and 10 seconds. So you have like these random offset bars. You're still going to see basically the same thing. Time and time delineations have no meaning outside of human understanding. That's a conversation for later, Douglas. Thank you. For people trading the chart, they all do trade the actual 5-minute chart and see the same formations. No, they don't. That's a serious misunderstanding. People like to say, well, institutions use the 50-day moving average. Institutions use Fibonacci ratios, and it's not the argument you're making, but these are things that people say, and they don't. A lot of algo traders are not trading specific formations, and they're not trading 5-minute charts. So I think that's a mistake. And obviously, only people who trade, so the 0-second offset is not random, but actually what's seen by everyone. Why do you say then you can see it differently? No, like what you don't understand here is, if we got 3 different data providers and we looked at 3 different, we took 5-minute charts from each of those, they would look subtly different. In some asset classes, perhaps massively different. In forex, this is where you might see very, very big differences. But even something that has a consolidated tape, like an actively traded stock, the charts will look a little bit different. So the idea that there is one canonical 5-minute chart to which everything else must bow, because this is the 5-minute chart of truth, that is not the case. It's just not true. And somebody said, what do I mean with different data feeds? So that's an issue of market structure, right? And everybody assumes that you have your chart. So what you see on your screen must be the same thing that everybody else sees. It's just not necessarily the case. Okay, let's roll into, let's go back and look at some of these other questions here. Have my thoughts on volume changed? I saw several questions on volume. No, I don't use volume. Somebody said, how can I justify not using volume? I do fine without volume. I don't understand. Yeah, I do understand the fascination with volume. Like, people just don't do stats on it. So volume is super highly correlated with range. One of the things you want to be careful of is looking at 2 things that show you the same thing. If you're looking at 2 things that show you the same thing, you're going to think you're making better decisions than you are, because you have 2 factors that are basically the same thing. And volume and range are very, very similar. There's, like, I don't know what to tell you about volume. My stance on it is not casual. It's based on quite a bit of work. I realize that a lot of people will tell you that volume is the most important thing, but most of those people who tell you things like that have not done, like, the back half of this book is full of a tiny bit of the statistical research that I have done. And people don't do that. They read other books, they look at patterns on charts, they embrace their cognitive bias, they huddle under the little tree that they've chosen to define how they see the market, and they brand themselves as whatever volume traders, and then they're committed to it, and they never ask the question, is this real? Do I need this? What could I do without it? It's a terrifying question to ask, You know, to go back to the first slide in the presentation, the people who advocate so strongly for volume, I don't believe they've gone through this process of questioning everything they believe. It just does not stand up. How to select time frame based on how long I want to be in a trade, and you can explore with that. If I'm learning to trade at age 40, do I have time to fail enough times? Yes, of course. It's never too late, and I think that the first of all, 40 is not very late at all, but I think that what you will do at your age with some life experience behind you is that you'll be able to you'll be able to approach this differently than you would have 20 years ago. And in some ways that will be constructive, but what you need to be careful about, I've seen many people, particularly one of the kinds of classics is somebody from an engineering background. Some of those people are wildly successful trading, but on balance, people from engineering backgrounds tend to struggle, and maybe struggle greatly, because they think the world should work in logical ways. And as I said, the market can be super counterintuitive. So I guess what I would encourage you is that if you are coming to this with some other career success behind you, you're going to be humbled as you go through the process. And he says he is an engineer. Okay, you're going to be humbled as you go through the process of becoming a trader. And I think you get to choose how that happens. The market, the market will do that to you. I would encourage you maybe to embrace that from the beginning, and to try to approach this with, if you're an engineer, I can make some good guesses about skills that you have. By the way, skills that I don't have, skills that you have that will serve you well, but also ways that you have solved problems in your past that are likely to backfire on you here. And so go into it, go into this process of becoming a trader with a sense of humility, knowing that if you don't do that, the market is going to do that to you. So you can choose that road at the beginning. And I think one of the keys to learning to trade is learning to fail well, and learning to learn from those failures, and don't neglect the emotional and mental side of it, which we'll talk about later. Good. And team, maybe comb back through the questions and see if I missed anything. I will do some more questions at the end. Somebody said it was hard to see the pointer, and I hope I did switch to the laser pointer enough that was useful for you. Okay, last part of the presentation, we will do some more Q&A. So drop more questions, and I also still have a few more questions here too. Okay, so charting by hand. This has been, if I look at the interactions I've had with people since I published the book, and I've written some blogs on this topic, this has kind of the most barbell distributions. I have had people tell me that this practice alone has been the turning point that made them profitable. And I've had people be completely baffled by how to do it, and many people be extremely disdainful and tell me it's a complete waste of time. So what do I say about this 10 years later? Well, I have here on my desk, I'll show you what I think about it. I have here on my desk, I still do a lot of work by hand, and I do it every day, and I would encourage you to just do it. Just commit to the practice, do it for a month, see what happens. How do you do it? So these are all options. You can write down daily prices for a handful of assets. That's what I've done here. I don't know why I thought it'd be cool to show you a page, but there's a page of numbers I wrote down. How thrilling, right? And what those are, they're closing prices for 5 or 6 markets. You could track more things if you wanted, volatility measures. I don't think you need to. Just write down the price, get in touch with the numbers. Do swing charts. This was the approach that I put in the book. We'll talk a little bit more about that. Draw candlesticks, draw bars by hand, do some work on printed charts. I'll show you some examples of that. But I am convinced that the the act of putting pencil or pen to paper and moving your hand is it engages a different part of your brain than if you do the same work on the screen with a mouse, or of course if you don't do it. Move your hand right. There is absolutely value in it. You can do this. Here's another example, the kinds of notes that I make every day. This kind of crosses into journal a little bit. You can see what I'm doing here is, some basic stats on the market, basic trend measures, some assessments, some expectations for next day, quick little graph of the previous day, assessment, and then, so this is important. This is the shot from the book. When many years ago, I had a chart of the S&P intraday that I did like this, and you have to pick your reversal. You could also do old school point and figure charts, like that's okay. I had this thing like stretched around my office that I just kept gluing pieces of graph paper to, and this will put you in touch with the rhythm of the market in a way that I don't think anything else will do. Do you have to do it forever? No, but I think if you don't do it, particularly, if you're making all the money you need to make trading and you're very happy, then fine, God bless you. But if you're struggling or if you're not quite where you want to be, try this and see what it can do for you. The most it's going to cost you is a few pieces of paper. Who cares, right? A little bit of time. And there's the chance that it might just blow your mind wide open. Here's another example. So I want to talk about this. Here's an affiliate link. Here's something I use every day. And this is the Remarkable 2 tablet. I'm a avid adopter and also returner of new technology. I had one of the first Kindles and I thought it was an absurd piece of technology and I returned it. I also had the Remarkable 1. Wasn't quite there. I bought it and returned it. These are not cheap. And I have one. My wife has one, which she manages to. But look, okay, I'll tell you how much we use these and love these. She manages to drop hers on a regular basis, and I don't understand because it snaps into the cover it's like a super strong magnet. You could stick this to the bottom of a jumbo jet and fly from New York to California, and it would still be stuck on the jet. Somehow, every several times a week, she manages to drop it, and when she breaks it, we'll buy another one if it can't be repaired. My one concern with this piece of technology is that, of course, it does have a rechargeable battery. There's no plan that I can see to be able to replace the battery. So, I do worry about the amount of material that we're making to put in landfills, and so that's my only concern. But this is a tool that I use constantly. I can't recommend it strongly enough. Don't use my referral link if you don't want to, but I think it'll save you, I don't know, 30 or 40 bucks, and gives me a little lunch money if you do use it. Great tool. What I have done with this is, so I took several years of charts and I lost track. I stopped counting when I got up to about 80 hours. I was doing both 1 minute and 5 minute charts. Actually, I did 4 hour. I did some dailies. I did some weeklies, and then going through and looking for specific patterns. And I found some things. One of the questions we had was, can you discover a trading edge by back testing alone? Meaning, can you just back test it? My answer is no. I would not trust anything that you back test, and I would not trust anything that I back test. At most, I would say that's interesting. Now let's forward test it, and I would forward test it either in a simulator, or ideally I would just go and start trading very small so I would have actual execution and P&L. But I did, I'm not saying that this is the only way to do it, because just a little interesting story here. I discovered something that was related to movements out of continuation with big bars, and I validated it over many tens of hours of work, hundreds and hundreds of charts and examples. And I thought, gosh, I kept saying, I'm surprised this worked. And then when I coded it, and did a long-term look at it, it pretty much only started working in the last 2 years. So, and then this raises a different question, right? But so this is very interesting because my intuition that this thing should not have worked was absolutely valid. But I also, in doing this work and in being faced with the data, uh, I did recognize something that I would have just dismissed if I were going on a purely based on my existing knowledge. So because I mean that's the goal, right? It's to figure out what you don't know and to expand your existing knowledge. And so what I've been doing is a lot of work with screenshots, which I can then export as PDFs to this tablet and then do the quote pencil and paper work on the tablet and then re-import back. And then of course you can put that into other back testing systems. But I think that's something that I would highly recommend. And this is not the only tablet out there. I've looked at a few of them. I really do like this one. And of course technology will evolve. So if you're listening to this 2 or 3 years down the road, there may very well be a better game in town. But today, if you don't have a tablet like that, give it a shot. See. Can you do the 5-minute charting by hand after hours? Yeah, you can. Sure, you can. I think there's a little bit of maybe a little bit of a benefit to doing it in the moment, but it depends. It depends. I wouldn't do 5 minutes actually. That's a lot of bars to draw at the end of the day. I think that I would. Yeah, I think if I were drawing candles, I'd probably do 30-minute or something like that. How do you scale a small account into a livable account while managing risk correctly? Well, so you're you want to have in mind, of course, that that's your goal is to sustain yourself from trading. But you need to realize that to do that is going to be it's going to be a lot harder than everybody else tells you it is. Okay, that's the reality. That's what, and this again, this is not great marketing, right? Because it's much easier to sell somebody a course and say just take this course and then you can make a living trading. But invariably people will take those courses and then they fail. And then what happens? You feel this, why did I fail? Is it because I just suck or I can't trade? No, you failed because you were lied to and because you did not have a correct assessment of what was involved in the task. That's why I'm telling you this. I'm not telling you that trading is hard to make you think it's impossible or to make you think that you can't do it. Quite the contrary, you can do it. You absolutely can do it. But I want you to know you're going to be able to support yourself. You're probably going to have a bigger account than you wished. And the idea you're going to support yourself from a $10,000 account, utter fantasy. Absolutely not. But the idea you could start with a $1,000 account and grow that into a $5,000 or $10,000 account, and then maybe get a little bit of outside money, friends and family perhaps, or just continue to grow and compound over the years. Of course, the issue here is that all it takes is one little mistake. What did I say at the beginning? It's hard to make money in the market. It's even harder to keep money because what will happen is after you've been doing this for a year, I've heard this sad story many times. Somebody starts with $1,000, they trade it up to 30,000, and then they get a little bit careless just once and they lose half of their account. They're really set back. So you can't do that. You cannot make mistakes. You have to eliminate unforced errors. You have to eliminate the mistakes that you can eliminate. And then don't. What I would encourage you is don't go into this thinking I'm going to make a living as a trader. Go into this thinking that I want to trade as well as I can. When I when I reoriented myself to reapproach intraday trading, I thought a lot about, okay, this I thought this is going to suck. I know this is going to be hard. How am I going to do this? And my guiding principle was I want to trade beautifully. And what does that mean? It doesn't mean like everything textbook, but it means that I want to trade with, I want to make as few errors as possible. I want to be in the moves when I see a market move, if it had the right kind of patterns to get me into that move, I want to have been in that move. I don't want to have made mistakes. I don't want to have made sizing mistakes. That's what it means to me when I say to trade beautifully. It does not mean that, if I could mark all my executions, I could put them in a book and they would look perfect. That's not possible. That's not reality. But focus, and I guess another way to say the same thing when I say to focus on, when I say to myself, trade beautifully, when I tell you to not think about trading for a living, even if that is the ultimate goal, it's a legitimate ultimate goal. What I'm telling you is to focus on process. So focus on the process of becoming a trader, focus on the process of trading. Don't focus on the goal, and certainly set realistic goals. If you're thinking, what's your yearly nut? What do you need? Do you need to make, you need to make, I don't even know what numbers to use. You need to make 100 grand a year. Don't think you're going to do that with a $10,000 account. You are doomed to fail. And if you succeed this year, then you're going to blow up next year. So that's why I'm telling you to have realistic expectations. Another question here. This one came with a picture. And this is why this format is good. So Nico sent me I never would have thought of this. So Nico says, I wrote a series of multiple inside bars on one time frame, usually contains a triangle on the lower time frame, a visual pattern that strongly suggests volatility contraction. Trading within triangles is usually a losing proposition. This is me on page 26, as the market is in equilibrium, i.e., no imbalance. I hate when people say i.e., and the actual movement within the pattern is highly random. However, everything's set up good breakouts. So he's asking me, is this pattern that he has drawn, his the mark there is his, is this what I meant by triangle? No, what I mean by triangle is this. And I never would have thought of that. And so if I was drawing the triangle in the lower time frame, what I would be drawing is this. This red triangle that he has drawn, which is in fact a triangle, is never a triangle that I would have thought of. And also, I never actually would have drawn a geometric figure with three sides, which is in fact a triangle, right? Anytime I draw a triangle on a price chart, I highlight a triangle, it's with these two sloping trend lines, because what I'm drawn to is these contracting swings. So that's a good question. It's a good misconception, and I am glad to have the chance to clear that up. Yes, Stan, I do know that book, and I mean, I do just fine without volume. This is more on volume. This is also a point where I see people get stuck a lot. If you want to use volume, are you going to hurt yourself? I don't think so. So if you disagree with me and you really want to use volume, I don't think there's anything wrong with that. Use volume. I will tell you that in my experience, it does not add anything to my work. I do just fine without it. I guess I would challenge you to see what, because part of this also, this goes back to the Bruce Lee thing, right? Strip away the inessential. Take away every fucking thing you don't need on the chart. Get rid of every line. Get rid of every tool that you don't need. And then, by the way, only what you don't need. So, like, I need bands. I need a moving average. I need that I'm not going to trade on the moving average, but I found when I take those off the chart, I can't trade. Like I need that structure. So, I know, and maybe you need volume, and that's perfectly fine. But what I'm challenging you to do here is to chip away, to strip away what is inessential, so what you are left with is what really matters. And then this gets us closer to the truth of what's actually going on in the market. What can you do to find ideas and theory of markets like I do? Well, one thing you can do is, so like I have a bunch of new ideas over the past few months because I've been trading very actively intraday. I've been evaluating my trades, and I've been doing a boatload of work in analysis, both statistical analysis and in work by hand. You can do the same thing. Look at everything I put out there, everything everybody else has put out there that resonates with you, and then do your own work. You're really going to not have a lot of success until you make this your own. And that's what I'm challenging you to do. And if you think volume is very important because other people tell you it's important, or because Wyckoff said it was important, I would be a little suspicious. If you tell me volume's important because you tried to take it away and it took something essential away from your process, then I will shut up to you about volume. So, and by the way, Paul just typed something in the box. One thing that one hand grenade you might throw back to me is, okay, Adam, you said volume's highly correlated with range. Do you think there's anything interesting there where you have a significant, I don't want to say divergence, you have a significant departure from that? Like, what about a wide range bar on very low volume? Or what about very high volume within a very small range? If you said that to me, I would say, that's interesting. That's not something I've looked at. I think that would be an interesting avenue for exploration. You're welcome. I'm just going to read through some of the questions we got earlier. Do I think it's important for one to truly understand how their trading method is being built? I think so, but I'm also a pretty big nerd, so maybe not. I mean, I do think you can get into, I think you can get into an area where you're so abstract, so focused on being right. And this is actually, like, I know this is one of my, like, mentally and emotionally and spiritually, this is one of my Achilles heels, is that I do like to be right. And I get caught in stupid arguments because I just want to be right. Sometimes it's a complete waste of time. Interestingly, I don't have that with the market because the market has kicked me in the soft, sensitive parts enough times that it's beaten that out of me. So I don't have that with trades. But I do think that there's potentially a danger when you go down this road of really understanding something, of trying to be like so precise and so right that it might be a little bit counterproductive. So I would be concerned with that. But if you're looking at some of the things I've talked about today and thinking it's a little bit over the top, or let's be honest, some of you are listening to some of the things I've said and you're a little scared because you don't want to look at what you're doing with quite that degree of detail. You don't want to know the answers. If you're one of those people, then in particular, I think you need to rethink it. Just looking through these questions. Some questions on scalability with timeframes. Let's make sure we hit those later. Questions on AI. I don't know is kind of the honest answer there. Folks, I think this is a good spot to wrap up. I appreciate all of your time and focus, and also welcome your feedback on these sessions. So we'll send a follow-up email. There'll be some blog posts. And we will do another one of these. We are going to experiment. Let me know what you think about the time. We're going to experiment with weekends. The next one is going to be on a weeknight, though. So we'll send the registration link out for that. And I think that's it. My brain's a little fried. Thank you. This has been good for me, and I hope it's been useful and interesting for all of you. And I'll see you back in the next one.